put on their lens and their expertise to help guide this particular family, the Williams family. So I do want to introduce Kathleen Bilderbeck. She will be our first speaker on the topic of split dollar. And Kathleen has been speaking nationally for many, many years. In fact, I'm certain most of you recognize her. She's an adjunct professor in the LLM program at Washington University School of Law. She's a founding member of the Affinity Law Group, which is a firm dedicated to providing legal services to businesses, their owners, and executives at every stage of their life cycle. Help me welcome Kathleen Bilderbeck.
Thanks, Rob, for that very nice introduction. Good morning, everybody. Thank you so much for inviting me to participate in the inaugural Level Up. I'm really excited to be here in Dallas. As Rob mentioned, my presentation today, if I can get the clicker to work. Aim it this way, okay. Well, we won't have any slides apparently, but we will have a presentation. There we go. Using split dollar to attract and retain employees. Now, for those of you who've never seen me speak before, I tend to do a highly interactive presentation. I ask a lot of questions as I'm going through my slides. If nobody answers the questions, this is going to be the longest presentation you ever sat through. However, if people answer the questions, it can be a highly interactive presentation. Now, as Rob mentioned, my job today is to talk about what we're going to do for the key employee of this company, Dawn. Dawn is the company's bookkeeper. She's been with the company for many years, and the family has considered transferring a small portion of the company to her. In this situation, why might it not be a good idea to transfer stock to Dawn? What are the aspects of this company that would weigh against that? Who are the owners of this company? A bunch of unrelated owners? They're family. It's a family business. Do we think that this family is eventually going to sell this business such that when the business is sold, Dawn, who owned a small percentage of the stock, would get money? Maybe. What does it say about their succession plan? Do they have a succession plan in place? And my experience with closely held businesses is if there is no succession plan in place, giving an employee stock isn't very meaningful to them. Also, if we give an employee stock, we have to figure out how to get that stock back if the employee leaves. What are the owner's intentions here? Why are they thinking about giving her stock? To retain her and to reward her for her many years of service. What are some other options that they could think about besides giving her stock? And don't go straight to the title of my presentation because there are other options. What are some other options? Bonus, executive bonus. That's very simple, very straightforward. Clients like that. What else? Deferred comp. That's another great idea. Deferred comp could be a great solution in this situation. What about on the equity side? Stock options. That's a great option too. That provides that, she's going to pay something for stock in this company, and therefore she'll have some skin in the game. But as I mentioned, maybe transferring restricted stock or giving her options here doesn't make a whole lot of sense. We could use phantom equity, right? We could give her phantom stock, which is basically another form of deferred compensation. It allows her to get cash at the end of the day, but the amount of cash that she gets is calculated based on the value of the company. What's an issue there? How do we know what the value of the company is if it's never sold? We have to get a valuation. I don't know about you, but a lot of my clients are very nervous about getting valuations for their company. There's a perception in the market, I think, among clients that valuations are expensive. And quite frankly, a lot of my clients, for whatever reason, it's like having your child valued. They don't want to know maybe the real value of their business. So those are all barriers to different types of equity plans and synthetic equity plans. So now we can go to the title of my presentation. What am I going to talk about today? How split dollar might be used to provide a benefit to Dawn in this situation. Does anybody notice anything in the facts about Dawn? How old is Dawn? Very young? Are we sure? Doesn't say, does it? So I'm going to talk about split dollar in a couple different ways. So we all know that split dollar is basically two parties, an employer and employee in this situation, sharing the costs and benefits of a life insurance contract. And there are two basic flavors of split dollar: endorsement split dollar and loan-based split dollar. Now, I've been practicing in the financial services industry since 1996. And when I came into the industry, split dollar rules were just initiating a change. Treasury was just initiating changes at the way that they looked at split dollar. First, there was a PLR, if many of you remember, in 1996, questioning how equity split dollar would be taxed. Then in the early 2000s, the split dollar rules basically changed. I think that really had a chilling effect on how much split dollar was being put into place, but I can tell you now there is a lot of renewed interest in the marketplace in split dollar. Also, how often do you think clients come to me and say, I want a split dollar plan? Never, never. Unless they've talked to a life insurance agent who suggested it, or a financial services professional who suggested it. So when you go out and work with your clients and you talk about split dollar, you're really introducing a new concept to them. It's not something that they typically read about on the internet or talk about in their entrepreneurs organization or Vistage groups. So we're going to talk about the two types and which type might work better in this situation for Dawn. So employer owned, we have endorsement split dollar. Here the employer owns the policy. The employer provides that the insured can name a beneficiary for the proceeds in excess of the employer's interest. Here the employer's interest is going to be the greater of premiums paid typically, or the policy's cash surrender value. The business pays the premium. The executive is taxed on the term cost of the premium. It used to be, does anybody remember when that was the PS 58 rate? Okay, so we all remember that. So now it's the table 2001 rate. That's when these tables changed. If the insured passes away, company gets its interest back, beneficiary of the insured gets the remainder of the proceeds. Now, what has changed? I know I'm supposed to talk about executive benefits today, but what has changed on the estate tax side that might make endorsement split dollar more attractive? That's exactly right. So the estate tax exemption as of the beginning of last year went up to $11.4 million per person. Now, when the estate tax exemption was lower, let's say $1 million or $2 million or even $3.5 million, if we had an employee who had an endorsement split dollar plan, and let's say the policy death benefit was $1 million, that would have eaten up, because they have the right to name the beneficiary under 2042, that policy would be includable in their estate for estate tax purposes. So if they had $1 million policy and only a $3.5 million exemption, that ate up a large chunk of their estate tax exemption. Now that the estate tax exemption is $11.4 million per person, there's less concern on the executive side about the estate tax consequences of these types of arrangements. So as I mentioned, we have the employer, he or the company has its interest. The employee's family is entitled to the death benefit in excess of the employee's interest. And we're up to the table 2001 rates rather than the old PS 58 rates. The other type of split dollar is collateral assignment split dollar. This is where the employee, or perhaps the employee's ILIT, owns the policy and provides a collateral assignment back to the company for the company's share of the proceeds. Here with collateral assignment, thanks to the changes in the early 2000s, we are now using loans to pay the premiums. So these plans are treated as though the company lent money to the employee to pay the premium. Whenever there's a loan, what do we have to accrue or pay? Interest, yes. And the interest here is a very real thing. Under the original pronouncements with loan-based collateral assignment split dollar, it talked a lot about imputed interest. In other words, if there's no stated interest rate on a loan, there's going to be, the IRS says there has to be imputed interest. So under 7872, interest on no interest loans will be imputed. And that's true of all no interest loans. I'm sure many of you have clients who want to give intra-family loans to their kids perhaps, and they say, well, I don't want to charge them any interest. Well, they can't do that. The IRS Treasury says you have to charge interest at least a minimum rate, and that's the applicable federal rate. The applicable federal rate changes depending on the length and type of loan. So if we have a demand loan, it's a blended rate, an annual blended rate. If it's a loan for more than 9 years, it's the long-term rate. 3 to 9 years, the midterm rate. Less than 3 years, the short-term rate. So in the beginning, I think there was a lot of conversation about imputing income in this type of loan-based split dollar. Now I will tell you, any loan-based split dollar plans that we do, we always state an interest rate, and it's generally whatever the AFR rate is at the time that the loan is made. And we're going to look at an example of that and how that carries forward over time. So here, company pays the premium, that's treated as a loan to the employee, interest is paid at AFR, there's a collateral assignment of policy values back to the employer, so if the employee dies, the employer is reimbursed for the loans that it made to the employee, and the beneficiary, the insured's ILETs, the insured's family gets the remainder of the proceeds. So as I mentioned, it has to bear interest at the appropriate applicable federal rate or income will be imputed. So what happens with collateral assignment when the employee's employment is terminated? How do we get out of these types of plans? Well, there are a number of different ways. One possibility is the employee pays back the loan. The employee can either pay back the loan out of pocket, or the employee can borrow against the cash surrender value of the policy with the employer's permission and pay back the loan through the cash surrender value. If the employee pays back the loan, they own the policy, they get to keep it, the collateral assignment goes away, and now the employee owns the policy outright. How many times do you think we actually have employees who come out of pocket to pay back those loans? Almost never. I will tell you in my experience, almost never. So what do we see as a practical matter? Generally, we see the employer forgiving that loan. The employer forgives the loan. The employee is taxed on the amount of the loan forgiven. Now, one important point, you know, I'm a lawyer. Rob mentioned I'm a lawyer, which means that part of what my firm does, part of the way that we generate revenue is drafting documents. We like to draft split dollar documents. One of the things that you don't want to put in the split dollar document up front is that the loan will be forgiven when the employee terminates employment. What is the reason for that? Does anybody know? Because then that could include an element of deferred compensation, which might make the split dollar arrangement subject to 409A. Being subject to 409A, which is the code section that governs non-qualified deferred compensation plans, has a whole lot of complications that go along with it. It's not something that can't be worked around, but it is something that you need to be aware of. So even if the plan at the beginning is that the employer is going to forgive that loan at some point in the future, that's not something that you want included in their documents. The third possibility here is, the possibilities are the employee terminates employment, separates from service, goes on their way, employee is living. Other possibility, the employee dies. Under the split dollar agreement, employer gets back its share of the policy proceeds, and the remaining proceeds are paid to the beneficiary. So why do clients like split dollar? Well, something that I should have said up front and didn't. We are doing split dollar for a lot of younger employees. Why would split dollar be attractive to younger employees? They can't afford that much insurance. And even the precursor to that, they need insurance. They're just getting married. They have young families. The insurance is important to them. They have an insurance need. Split dollar is not going to be that attractive if there's no insurance need. So that's one thing that you have to keep in mind when you're working with clients. And it does provide a significant amount of coverage for a very low out-of-pocket cost. Also, that cash surrender value will be around potentially to provide supplemental retirement income for the employee. Let's say that remember that the employer's interest in the policy is capped at whatever the loan value is with collateral assignment split dollar. What happens if the policy performs better and the cash surrender value of the policy is greater than the loan? In collateral assignment, the way I just described it, loan-based collateral assignment, what does the employer get back at the end of the day? The loan value, the premiums that they've loaned, plus interest, but we'll talk about that in a minute. So, this can provide a substantial source of supplemental retirement income for the employee. It's a selective benefit. The employer can decide exactly which employees they want to benefit with split dollar. It has very few ERISA requirements. The two big ERISA requirements here are the split dollar agreement needs to name a fiduciary, and it also has to have a claims procedure. Now, don't be like my partner. I have one partner, no matter what executive benefit plan I draft, if it's got ERISA claim provisions in it, he wants to cut them out because he says that makes the document too long. And I repeatedly have to explain to him, ERISA requires these provisions to be in here. So I can cut them out, but then the plan won't comply with ERISA. We want to make sure that the claim procedure and the name fiduciary is included. There's minimal administration here. One of the drawbacks that I find with traditional non-qualified deferred compensation plans, they can be very simple or they can be very complex. And the more complexity is involved, the more chance that the employer is going to have to get a third-party administrator to administer the non-qualified deferred compensation plan. This is pretty straightforward in terms of administration. So the client really doesn't have to worry about their CFO spending a whole lot of time managing this split dollar arrangement. What are the cons? Well, we're going to look in a minute at an example of how the economic benefit in endorsement split dollar can become prohibitively expensive over a period of time. No deduction for the business's share of the premium payments. I don't find that clients really find that to be too disturbing. I think they're used to not having a deduction now for life insurance premiums, although, sorry, I just made a huge noise, virtual audience. I apologize. Although, if we were doing an executive bonus plan, for example, then the employer would get that upfront deduction. So if that's something that's very important to them, maybe that's another plan that should be examined. And the perception that split dollar rules, taxation rules, are complicated. That came out of the fact that in the early 2000s, those revenue rulings and revenue procedures that came out seemed to create a lot of complexity. It's really not that complex. It's not the level of complexity that your clients can't deal with. So I get the question a lot when I'm working with producers about which type of split dollar arrangement to use with specific client groups. And always, it's a facts and circumstances decision. So there are always going to be facts in any client situation that weigh in favor of endorsement split dollar, other facts that weigh in favor of collateral assignment split dollar. What do you think would weigh in favor of endorsement split dollar? Client comes to you and they say, I have a client base that's what? Younger or older? Older. Anybody have a different answer? Younger? I'm going to tell you, in my practice, in my experience, we use endorsement split dollar a lot with younger client base. Also, either plan can be used to recruit, retain, reward. In endorsement split dollar, who has control over the policy? The employer, because the employer owns the policy. In collateral assignment split dollar, employee owns the policy. Those facts, which of those two facts weighs in favor of which type of plan is highly dependent on the client situation. So let's look at what happens where we make Dawn 2 different ages. I can do that because she doesn't have a specific age in the document. So my friends at Emeritus helped me out with some illustrations. The first one uses their Keystone Foundation Whole Life products with a $1 million initial face amount. And we ran these illustrations with Dawn being 31 years old when the policy was issued. And in the other example, she's 49 years old. And as you can see, the premiums are substantially different. But in addition to the premiums being substantially different, the difference in premium doesn't really match the difference in the economic benefit. If you look at, and Dawn's a younger employee, if she's 31 in year 1 for $1 million worth of coverage, she's going to be taxed $163 on the economic benefit. That's something that I think even a 31-year-old can probably absorb. Even in the 30th year, she's only going to be taxed on $1,244 of economic benefit. Now compare that to if she's 49 years old and we're paying those premiums for 10 years. In year 1, she's going to be taxed on $403. That will be her compensatory income. But by the time we hit the 30th year of this contract, of course, I know she'd be 79 years old and still working, but let's just go with it. If we hit year 30, she's paying an economic benefit. She's paying tax on $8,615. So as you can see, this works much better, in my opinion, for clients at younger ages. So now let's look at how collateral assignment split dollar really works from a tax perspective. So now we're going to go with loan-based collateral assignment split dollar. We're assuming Dawn is age 49. She plans to retire at 65. So here we're going to put this split dollar agreement in place. Again, Emeritus gave me some nice illustrations of their growth index UL product. Again, we have an initial face amount of $1 million and it's on a 10-pay premium structure. The way that these illustrations were run, remember what I said about term and demand loans? The way that these particular illustrations were run, the plan was structured using demand loans with a blended annual rate of 2.42%. Now, before I go on to my next slide, I do want to mention something about demand loans versus term loans. Every time that a new premium is paid, maybe I will go ahead and just talk about this with the illustration. Every time that a new premium is paid in this scenario, it is a new loan to the employee. What does that mean from a promissory note perspective? If you're making a new loan, you need a new what? A new note. So we're doing it, this is like a lawyer's dream, right? I got 10 years of steady work here doing new notes every year. And if we have a new loan every year and a new note every year, what does that mean for the interest rate on these loans? It's going to go up and down depending upon, the AFR is published monthly, right, by the IRS, Treasury. So it's going to depend on the month that the loan was made. So over time, we have lumpiness, right? The blended annual rate, that's determined once a year. It's, as it says, a blended annual rate. So with demand loans, we're going to have a new rate every year. If you want to lock in a rate, the best way to do that, what do you think that is? Demand loans or term loans? Term. So we can use the term loan for a long period of time. What happens then if you've got a term loan and the rate goes down? You can amend and restate your note. I mean, that's a possibility to lock in the new rate. If you have demand loans, you're going to be stuck with whatever the blended rate is at the time that the loan was made. Remember also, if you have demand loans, technically the employer could make demand on getting that money back at any time. And that may or may not suit the client situation. So here we did use a blended annual rate of 2.42%. We're saying that that's going to be the average over the term of these loans. So every year there's a new loan to Dawn, and there's interest on that loan. The interest has to be what? Paid, accrued, or forgiven on an annual basis. How many times do you think it's paid out of pocket? I would say not zero, but certainly not a large percentage of the time. How often do you think it's accrued? What happens if you're accruing that interest? The loan increases, exactly. So that's going to eat into the death benefit that the employee's family is going to get at the end of the day. So what's a more common strategy, would you say? To tax, to forgive the loan interest at the end of the year. That creates compensatory income for the employee. Yes, the employer can, if they choose, gross up that payment to take into consideration the additional tax. But I would say typically that's what we see, that the loan interest is being forgiven on an annual basis. So as you can see, in the early years, the death benefit, the initial death benefit, remember, was $1 million. You can see in the early years, we're a little bit under $1 million, but still we're in pretty good shape. When you think about that final column, that's the year-end policy death benefit net of loans. So that's after the employer is paid back. It's a pretty good deal, I think, for Dawn, don't you? If the premium is $42,000 and all she has to pay is the interest. That's why these plans are appealing to slightly older employees. So then let's take it through her retirement at age 65. So at age 65, the cumulative loans are $424,854. She is paying interest on an annual basis of $10,281, and she's got a death benefit over $1 million. Now she's going to retire. There's a choice that can be made. She can either repay that loan, or the company can basically forgive the loan, and that will count as a taxable bonus to her. That was fast. I went through that very fast. So, what questions can I answer? Yes? That's a great question. The question was, the loan regime is not available to public companies. And part of the issue with that is Sarbanes-Oxley. It is frequently problematic in the public company arena. In my practice, that's a great question. That leads me into who we represent and what we do. My partners, probably somebody out there is watching in the virtual audience and thinking she didn't mention one thing about this law firm. So as Rob mentioned in his introduction, we represent business owners at all stages of the life cycle. We have a very robust mergers and acquisitions practice and a very robust corporate practice. My personal practice is estate planning, executive benefits planning. Our clients are everything from small, closely held companies to extremely large, closely held companies. One of our clients sold his company this year for $370 million, but it was a closely held company. So we don't get into a lot of the public company issues. You can use endorsement split dollar, yes. And I would say that we certainly see a lot more, when we do have executives come in who are with publicly traded companies, we see a lot more stock plans than any kind of split dollar arrangement. So we're seeing a lot of option plans, even restricted stock, usually, or appreciation rights. Usually they're going in an equity direction. Not so much. They could do both. They could do a split dollar plan and also have equity plans. And it's not at all unusual to have clients come in and they've got all different stock options. You know, if they're from a publicly traded company, typically they'll have some incentive stock options, which I'm just going to give my 5-minute overview of stock options. So incentive stock options are only available to C corporations. And the reason why executives like them is they get stock options, they can buy stock at a particular price at any point in the future, and it's a 10-year window, usually, for them to exercise. Once the stock value goes up, they exercise their options. There's no tax at exercise. Later, when they go to sell the stock, they are taxed, but there's only a tax at capital gain rate. So they never actually have to pay anything at ordinary income rates. Typically, when we're working with publicly traded companies, there will be some incentive stock options, perhaps some non-qualified stock options. The difference there is there's still no tax when the stock options are given out, but when the employee exercises a non-qualified stock option, they're taxed on the difference between the strike price, what they're paying for the stock, and whatever the stock value is. And then later on, when they sell the stock, they pay tax at capital gains rates. So usually there's a layering. There's incentive stock options, non-qualified stock options, maybe even some phantom stock, but typically we're not seeing split dollar in that market. That's not to say that we never do or that it's not available, just that I would say it's not typical. Yes, sir.
Can you comment on the cost of establishing a two-person?
Can I comment on the cost of a 2-person split dollar?
Yes.
Is that the attorney cost?
Let's say the total cost.
Total cost. Gosh, that's a great question. Part of it's going to be dependent upon, you know, the illustrations. If we're talking about total cost, how much coverage they're getting, what the age of the client is, what their health status is, all the typical things that you talk about when you talk about life insurance. From a drafting perspective, it depends on what city you're in. I mean, if we were doing it and the terms were the same, I would say, putting me on the spot, let's say $3,500. So I'm trying to decide if he's saying that's reasonable or not. I'm trying to figure it out from the front of the room. So I would say, you know, depending upon what the premium is, it can be expensive or not. Am I doing that? Am I getting reverb?
Might be mine.
Okay. Yes, sir.
Given today's global society and global workforce, how do you counter the employer's question, why should I be putting all this money into a plan for a 35-year-old who is going to move and leave?
That is a great question. So the question is, just to repeat it for our virtual audience in case they didn't get it all, how does split dollar dovetail with the more mobile workforce? And how can you convince an employer to put money into a plan for a 35-year-old who will probably leave and go somewhere else? Again, if you have employer endorsement split dollar, they own the policy, they're in control of the policy. The employee's right is to endorse that death benefit. If the employee leaves, who owns the policy? Employer. On collateral assignment split dollar, they have a loan. They're obligated to pay that loan back. The documents say they're obligated to pay that loan back. If they leave, what happens? The policy is surrendered, potentially, basically, the employer is going to get its interest back, perhaps through a policy surrender or through loan repayment. I mean, in that situation where the employee is leaving, the employer is not going to be generous and say, you know what, we're just going to forgive this loan. I would say that that's very unlikely. In Dawn's situation, where she's been a long-term employee and she's going to stay until retirement, it's not at all unusual for the employer to forgive the loan. And actually, I would say that this is one of the things that's actually more appealing about split dollar with the more mobile workforce. Certainly with the younger employees, the 35-year-old with the endorsement split dollar, it can be temporary. But the employer gets a policy. Yes, sir.
is it ever possible to consider using premium financing to cover the split dollar arrangement, or is that too complicated?
The question is it ever possible to use premium financing to cover a split dollar arrangement? We actually have several active cases right now with premium financing and collateral assignment split dollar. Typically, where we're using premium financing and collateral assignment split dollar is for the owner. The owner has to be sophisticated. I will tell you as a lawyer, if it does not go as planned, the employer will suddenly be very unsophisticated. So it's very important that you have the right clients entering into this. And who are the right clients for premium? I'm not going to get on my premium financing soapbox. I think it's a tool that is very useful in a lot of situations. But who is the ideal premium financing client? Someone who doesn't need the money. That is correct. And because our client base is closely held business owners, the reason why they're using premium financing is because the return that they're getting in their company is better than, the loan rate on the premium financing. So yes, you can use it with premium financing, collateral assignment split dollar. I think it works out extremely well in the right client situation. But I will warn you to document, because clients frequently have short-term memory loss when things don't, or even long-term memory loss when things don't quite work out as they anticipated. Uh-oh.
I have several questions from our virtual audience. If a company has 2 key employees of varying ages, can different products be utilized to maximize benefits and reasons for employer and employee?
Yes, different products can be used. Different products can certainly be used because it is an individual selective benefit. So, these policies are going to be individually underwritten. Andrew, my emeritus friend, is back in the back. We could use the whole life contract in one, and we could use the universal life contract in another with the same company. That's not a problem. And I'm not a product person. That's not my job. So when I'm looking at split dollar arrangements, I'm product agnostic. So I leave that up to the life insurance professional to decide what's the best product to use with each employee who's participating in a plan like this.
Another one, is there a minimum cash flow pattern needed to even consider a program like this? 3 years, 5 years?
That's a good question too. So a minimum cash flow pattern, I would say the minimum cash flow requirements are highly dependent upon what premium has been illustrated. So in this, loan-based collateral assignment case we have here at the end, we're committing to 10 years of $42,000 premiums. Does the company have lumpy cash flow? If they have lumpy cash flow, maybe this is too much. Maybe it's not the right plan for them. Maybe we look at something else. We are still doing more than anything at my office. It's phantom stock plans. Clients love them. There's not a lot of upfront cost. They don't have to commit to any cash flow outlay, but they do have to commit at the end of the day, whenever those benefits are payable, they have to pay them. So that is, at some point in the future, and usually the payout points under those plans are very well defined, like if there's a change of control in the company. Well, if there's a change of control in the company's going to have money to pay the benefit. So it's kind of a different analysis, but here they at least have to have the cash flow to whatever premium structure they are committed to. And of course, there's always the chance of a recession. And again, that's something that it's out there. I'm not a financial expert, but I know the yield curve inverted and people think all different things about that. So you all can tell me what I should think about my investments in the recession. Next question.
Okay, so this is a multi-part question.
Oh gosh, just like
Okay.
law school.
Yes, exactly. It's
Okay.
like an essay. So if an employer leaves and the loans are settled, can the employer keep paying on the policy? Can the employer use the cash value in the policy as the policy grows? And is there a limitation to keeping a policy for a past employee?
Okay, all great questions. I am going to take the last question first. So if it is an employer-owned policy, we get into the notice and consent requirements of Section 101J, that the employee has to consent to the company owning a policy on his or her life. Can anybody remember why we have that rule now? Walmart. Everybody can come up with that answer. I've asked that question several times this month, and they can always come up with the Walmart answer. That's right, because Walmart was buying policies on everybody who worked for them. Everybody from cashiers to janitors to top executives. And then some of those employees died, and the family said, well, where's our money? And Walmart said, you don't get any money. Those policies are owned by Walmart. So after that, again, seeing a problem, Treasury put in 101J, notice and consent requirements. So the executives have to consent to the company purchasing life insurance, insuring their life. The company has the right to continue to own those policies after the employee leaves. And in many, many cases, they do. Think about your basic non-qualified deferred comp plan, where we're buying those policies not only to provide benefits for the employee, but also for cost recovery for the employer. If we didn't have those rules that they could continue to own the policy, cost recovery would not be possible. So the other questions, the first one I think was about, can the employer keep the cash surrender value?
Mm-hmm.
Okay, so if we have a loan-based collateral assignment policy, of course, the employee owns the policy. So the employer has the right to get repaid at termination of employment, but they don't have the right to keep the policy because they never owned it. With endorsement split dollar, we have a different situation. There, the employer owns the policy, and yes, potentially the employer can still own the policy after the agreement is terminated. Was there a middle one? I think there was, and I can't remember what it was. Okay, I got it. Thank you. Any more from the virtual audience? Thank you, virtual audience. I appreciate the questions. Well, it looks like my time is just about up. Rob, is that true?
Yes,
Okay.
that is true.
They're waving me off
Thank
now.
you.
So thank you all. I'll be around for questions at the end.
Great job. Thank you. If I start with, this is a compliment that probably catches everyone's attention. Kathleen, when you were speaking, it reminds me of a Institute FSP national conference I was at, one of the sessions, and this guy ran up to me after and he said, don't you love nerding out? And I felt like, that's a compliment. This is technical. This is fantastic.
I don't know how I feel. Thank you very much.
And we have the Performance Plus Purpose Conference coming up. There's many opportunities for us to continue to enhance our learning. That was fantastic. So I'm thinking about the case, and we have Dawn. We have many opportunities or options or ways to kind of lock her up. I would put that under, the retention of the key person, rewarding. Also, if we think about business continuity, Mr. Williams, he came to us and said, I need some help. I need some guidance. Mr. Williams is 54. We want to make sure that that business is somewhat predictable going forward. And obviously paying attention to the key people and keeping them as part of the company will be helpful. So from a business continuity standpoint, very helpful in those particular areas. Next, you're going to hear from Stacy McMahon and Bruce Gendine. Stacy is a consultant in Pacific Life's Advanced Designs unit. She focuses on business planning, executive compensation, retirement planning, and estate planning. She also provides advanced sales training and has presented to prestigious life insurance producer groups, professional advisors, and other financial organizations. Bruce, as president and co-founder of the Cenex Group, Bruce works with advisors nationwide to deliver seamless solutions that enable them to provide complete end-to-end qualified retirement plan to their clients and generate a significant new revenue stream. Bruce is also a sought-after speaker on the topic of qualified retirement plans. Bruce spends much of his time touring the country, sharing insights with financial services professionals. Stacy and Bruce, please come up. Split-funded defined benefit plans, qualifying for the 199A deduction.
Thank you, Rob.
Thanks, Rob.
Can everyone hear? Good? Sound check? Okay. Thank you, everyone, for joining us. This is our inaugural Level Up meeting, and I am very grateful to have Bruce come up here with me. We are going to be tag teaming today, as you can tell, and we'll walk through, as soon as I find the remote here, we're going to walk through that same case study, and we had a lot of fun, right, co-speakers, with this case study. It went through various iterations to make sure that it worked for all of us. So we're going to see here, a couple of things might be a little bit fluid. Dawn, we believe, is a time traveler because she changes ages throughout these case studies. So not sure how she does that, but she's very gifted. I see why she's a key employee. All right. So we do have, just to give a little bit more of an introduction of Bruce. Bruce and I have talked, I think we talk almost on a weekly, definitely on a biweekly or monthly basis. I have questions about qualified plans, using life insurance. He can do this in his sleep. Me, not so much. I have a little bit more of a broad expertise. But what I love about this topic is our business owner clients. How many of them would you say, or would you say a lot of your business owner clients are not saving enough for retirement? Like, so you have some clients who they're pouring their money back into their business, they're paying for their kids' education, college, etc. We see this as a really big need. And at Pacific Life, because we did have as Kathleen pointed out, we have the doubling of the estate tax exemption amount. It is going to revert back in 2026. It's going to sunset back to the 5 million per person index for inflation. But who knows what's going to happen with the next election and all that. But we saw an opportunity to really focus on business owners and what are the business owners' needs. So we have been talking about executive benefits, retirement planning, and certainly just general financial planning, family protection for those business owner clients. This is the longest title, I think, in Pacific Life history of a presentation, maybe in the industry. Oops. Okay. So to sum up our version of the case study, Robert is our main focus. Okay. Kathleen talked about what we're going to do for Dawn, our time traveling key executive, bookkeeper person. She does play into this because she is that key employee. We are going to make her a little bit younger, but Robert's our client. Robert is our business owner. He does have 2 siblings, Sean and Nicole. Happens to be an orthopedic group. Apparently, anytime you have a kind of doctor or orthopedic group, as we have in this case, those owners have to also be orthopedics. So I think somebody's having knee surgery, which is very convenient for the orthopedic group. I don't know if one of the brothers or the sister is going to do the surgery or who, but they've got it taken care of there. We have a business with a predictable, steady income, and that's going to be very important, certainly for any type of retirement planning, but especially for qualified plan, I would say. We want to make sure that that's clear. And our key employee, Dawn, we're going to make her much younger, and we're going to still keep her age a little bit vague. What would you say, Bruce? How old do we want to make Dawn?
I think she was in her early 30s.
Let's make her 30. Yeah,
Yeah.
She's in her 30s or 29 with a few years of experience. And yeah, Dawn is key with any kind of qualified plan, as Bruce will talk about here in a minute. It needs to be subject to those non-discrimination rules. We cannot discriminate just for the highly compensated folks. We need to include all eligible employees. So we're not going to leave Dawn out in the dark, but we're going to talk about how we can kind of help compensate Robert and help him save more for retirement. He's our client. You can see Robert and his wife have the 3 grown children. And when we talk about 199A, how many have tried to read section 199A or talk to a CPA and try to figure it out? Okay, it's very complex. We'll see in a couple slides here. We're going to distill it down to about 2 or 3 slides, which is impossible to do. But we just can't talk about it for the entire hour or 45 minutes here. But it is based on qualified business income, right? We're going to take a look at that qualified business income and how we calculate the 199A deduction. It's going to incorporate both the qualified business income and Robert's total taxable income. Just to keep things very simple, we are going to have his only income is that QBI. Okay, just going to make this very simple because it's already a complex set of provisions and rules. We're just going to keep that very easy. Another thing I want you to notice is that we have an LLC here. So it's a pass-through. That 199A deduction is only available for pass-through businesses. So an S corporation, a partnership, or an LLC. Or it could be a sole proprietorship, I suppose. Oh, there's our buzzing again. We have a bumblebee in the room. And I think that's what I want to focus on here. But we want to make sure that, just keep all this in mind, and we'll keep reminding of you of everything. There is a special note on S corporations. If they are taking, reasonable compensation from an S corporation, is not going to be considered QBI. So we made this an LLC to take away that factor. And it is going to be a specified service business. So we'll see some limitations of the 199A deduction because of that fact. All right. So we always try to talk through when I get calls, consultation calls, conference calls, and office visit meetings, and what have you. One of the first questions, type of questions we start asking is, what's your client situation? What are they looking for? And as you can read in the case study, we will, not sure if there's a sweet spot where I'm supposed to stand. In our case study, you'll see that Robert wants to save more for retirement. Now he does have, you'll see on the back side of the case study that there's $1 million of retirement funds. And we're not sure what that is, but in our case study, that's going to be, he has a defined contribution plan in place. But he does want to get some life insurance protection. I think he has only about $1 million. I think Margaret, his wife, has a little bit of life insurance protection, but they want a little bit more death benefit proceeds. And they're also looking at cash value life insurance. He wants to catch up on that retirement. He's mid-50s and has $1 million saved up. So that's, if he wants to work for another 10 years, he's going to have to really ramp up his retirement savings to get to a comfortable retirement savings bucket. I did mean to mention, and Andrew asked me to mention this, we want to make sure you all are invited to ask questions during our presentation. There will also be a Q&A at the very end. After all of us speakers have finished, there's going to be a big Q&A. We'll all be up here, and you can fire questions away at all of us at that time as well. So I just want to make sure everyone do that. We're catching up on retirement savings, and he wants to qualify. He hears about this 199A deduction, and Robert is intrigued. I want to know more about this 199A deduction. Right now, I'm not, getting any. It's supposed to be 20%. Where's my deduction? Why can't I take advantage of this? And that is because his income is a little bit too high, as we'll see here in a minute. This is the last slide I'm going to touch on for right now, and then we'll switch over to Bruce to get into the nitty-gritty details of 199A, his favorite code section, after 409A. And just a couple of basics here. As I mentioned, it's set to sunset in 2026, so December 31st, 2025. This will no longer be available unless law changes. It could actually end earlier if somebody enacts some new legislation as well, of course. And we saw how this tax reform went through very quickly. They had to use the Byrd Reconciliation Act and those rules. Everything had to be paying for itself. So they had to have a few things sunset, and this was one of them. So we have a short window here. What is it, 6 or so years left, which is a pretty good timetable for our premiums and setting up a defined benefit plan to help Robert save for retirement. As I mentioned, that pass-through income from S corporations, not the reasonable compensation, but just any pass-through. So if they're taking a K-1 distribution, as long as they're taking a reasonable salary, they're going to be able to get that pass-through income, and that will be the QBI, the qualified business income, that is subject to the 199A deduction calculation. Again, those sole proprietorships, partnerships, all are going to qualify. And there's our definition. It's the deduction is going to be the lesser of that 20% of QBI or 20% of their taxable income, less any net capital gains. So whichever is less. And then they're going to take that, if they qualify for the whole 20% deduction or whatever, maybe part of it can be phased out if they make too much money. or if there's another test that we'll see here in a second. Anyway, you take that deduction, let's say they got the full 20% deduction, that's applied to their total taxable income, and 20% right off the top. So a great way to introduce, here's a retirement savings plan, Dr. Williams, but also we're gonna get you some tax savings as well. So I will let Bruce talk about the details of 199A.
Thank you.
Yes, thank you.
I have a dear friend who's 30-year practice as a CPA and tax attorney says 199A is the most complicated piece of tax legislation she has ever seen. So when I give you about 10 minutes of this, please be assured it will not be as deep as you may want to go. Let me talk about a couple of things here. 92% of closely held businesses and professional practices are pass-through entities. So that's our marketplace. So I can tell you that virtually every client that you run across is dealing with 199A. And every CPA that you deal with, and I've had numbers of conversations, I've done seminars for CPAs on 199A, and they're all pulling their hair out. And the reason is that they used to be tax planning or tax preparation, even limited to. And all of a sudden they find themselves in compensation planning, they find themselves in entity planning, and things that they haven't been doing before. And this has really upped their workload. And so I find that if you know something about 199A and how to control and make sure the client gets the deduction, you can become very valuable to that accountant. Keep in mind, this is against a backdrop where rich clients have lost virtually all their itemized deductions. You know, the SALT deduction, state and local tax. I was talking to a friend in New York. He says, yeah, that's really a good deduction, that $10,000. He says, that's great. He says, my property taxes are only $40,000. And then there's the state income tax and the, you know, and on and on and on. And so they were terribly beaten up in their deduction side. So this is a deduction they need very badly because you'll see it can become a very big item. Well, to make things particularly complicated, they broke the world into two parts: service businesses and non-service businesses. Let me start out by saying a non-service business is not one that gets low Yelp scores, okay? By definition, a non-service business is one that gets a material amount of their income as a result of capital. So capital is a material income producing factor, meaning that they have inventory, they have plant and equipment, and so on. I'm sorry? Oh, anyway, so that's the one side. The other side, the specified service business, sometimes abbreviated SSTB, trade and business, trade or business. Those are the sort of the usual suspects. You know, health, doctors, dentists, CRNAs, veterinarians, all of those kinds, lawyers, accountants, actuaries, so, but they did something that was really unique. Out of all the definitions in the past, they took two occupations out. Anybody know what they were? Engineers and architects. And that was out of section 1202 for those of you who are code section people. And then they went back and they added some folks in section 495. And those people, oh gosh, I don't know if you'd know anybody in this, but they're called financial services. Financial planners, broker dealers, you know, brokerage. Okay, and they came in. And so you broke the two down and they treat them exactly the opposite. Let me explain. Up to the threshold amount, and let me use that term, and the threshold amount is 321 for this year. It is indexed with inflation. It was 315 last year and so on. So up to the threshold amount, they're both identical. That's where it stops. If you're a specified service business and you start over the threshold, your deduction is decreased. Okay, it's phased out dollar for dollar above that on a percentage basis until you reach $421,400 for married filing jointly. So a $100,000 range, and it totally goes away. If you're a service business, it goes just the opposite. It says when you hit the 321, when you go over it, you phase into another form of testing. It's called wage and capital testing. So you get the lesser of 20% of the qualified business income that was passed through. Let's take an S corporation, line 1 on the K1. Okay? The minute it goes up, you're going to start measuring. You could offset it against 50% of wages. That's wages for all employees, not just an owner. But remember, this is passed through to your personal return. So if 3 of us have an interest in this company and I'm doing one thing tax planning wise and you're doing another and you're doing another, guess what? They'll all look different. It's not like this is your number and everybody gets that. So what happens is you get this phase out. So it could be the lesser of 20% of QBI, qualified business income, or 50% of wages paid, or 25% of wages paid and 2.5% of capital. Here's what capital means. It means things you acquired in the last 10 years that are not fully depreciated or expensed. So it's your cost. I don't know how that got in there. There was this gentleman, I believe his name was Bob Corker. I think he was a senator or something from Missouri. And he's reputed to have about $7 million of real estate income each year. So 2.5% of his undepreciated holdings is a huge number. So it offsets that and gives him these big deductions. And that's what's happening with the wage and capital testing. And so once you get over 421, it is all wage and capital testing against the pass-through. And over here in the specified service business, you're out of gas. You lost the deduction unless you can do something to bring that back in play. So guess what we're talking about today? How do you bring it back in play? So I'll turn the page and I told somebody yesterday I'm not allowed to wear black suits. My technical skills are such that people would think I was Amish, but so if I make a mistake, I'll have to draw on someone who knows. But anyway, what you're trying to do is you're trying to get like a qualified pension plan that has a large deduction to bring you back down to that threshold amount so you capture and can take full advantage of the QBI deduction. And in defined benefit plans, they work basically backwards. We all know 401k and profit sharing work like a savings account. You put money in, it'll depend on how many years you put it in and how much it earns as to what you have. A defined benefit or cash balance plan works just backwards. It says, here's the benefit I want. Tell me what I need to do today, given these assumptions. And that's what determines how much money goes in. And that number could be 2, 3, 4 times what you could contribute to a defined contribution plan. So, you know, all the contributions to the plan are tax deductible. And the point I want to make is it doesn't matter if you are a sole proprietor, a partner in a partnership, a S Corp shareholder, a C corporation, they're all deductible. It depends how they get deducted and where they are. So for example, a sole proprietor deducts his employees on the Schedule C, and he deducts his on page 1 of his tax return. So it's just a presentation difference. There's no other particular difference. One of the things that doctors look for in these plans, and most of you would know this, and that is they're looking for asset protection. And ERISA offers unlimited protection, assuming the plan is subject to Pension Benefit Guaranty Corporation. What that means, I call it the OJ effect. It says that guilt and innocence is not an issue, but if you have a $33 million judgment against you, and you have a Screen Actors Guild pension, and you have an NFL pension, and you have a private company pension, they can't touch it. And even if you go to Las Vegas and take a gun and try and get your trophies back and get thrown in jail, they still can't touch it. So that's fairly good asset protection. So the other thing that I want to point out is that 85% of the plans we do have a life insurance component in them. And the reason is I'm a very big believer that life insurance enhances the plan, not just for the general rules that you have that say that I am going to, if it's for me, just tell them I'm busy. You know, it gives you a little larger deduction. It self-completes the plan in case of an early death and all of those sorts of things. I look at it a little differently. Retirement plans have good news and they have some bad news. The good news is you get to deduct the contributions. That's good news. They grow tax deferred, even better news. The bad news is somebody's going to pay taxes when they come out. Okay? That life insurance that Uncle Sam, remember, if I put it in the plan, Uncle Sam is going to pay his fair share, which is what we want. He asks us to pay our fair share. He'll pay his fair share of that premium. What I want is that life insurance to be a wealth replacement for all the income taxes I paid. Just like when you were doing estate planning, you were going to pay the tax, but you had life insurance there to replace the wealth that you inevitably lost to the estate tax. Well, this is the same kind of a relationship. I'm going to replace what would have been lost to the income tax, whether I got taxed on it or my spouse or my kids or my grandkids. I'm not good at this reveal stuff, so well, a couple of things here that I think are important. Some people don't understand when you put insurance in a plan, and I'm going to kind of jump down to the middle of the page. You see, life insurance potentially increases allowable contributions to the plan, 247.9 without, 278.9 with, or you could have 294. How could that possibly be? Okay, first of all, the difference between uninsured and insured is very simple. It's not the premium that's the difference. It's the premium minus the cash value that's the difference in funding. And it costs a little bit more, not because the insurance is a bad earning product. It costs a little bit more because I have an additional death benefit. I have a benefit that I don't have in an uninsured plan. So if I had a health plan and I added disability to it, I'd expect the premium to go up. The same thing occurs here. The 294, I'm not going to really get into too deeply, but let me explain. With the Pension Protection Act came a new funding method, and it's got a cool name. It's called the cushion amount. What it says is I can always fund, in addition to the funding I have to do, the benefits that were earned this year, I can always fund 50% of the target liability of the plan in addition. So if I had $1 million of target liability at that year, I could put an extra $500,000 in the plan. The government's idea about doing this was when companies were having good years, they wanted to induce them to put more money in and get ahead so that they could stay ahead of the funding. And then when they were having not such hot years, you can imagine there's a minimum, because if I don't put it in, I get less, right? So when I'm having not such hot years, I can put a lot less in. So it gave this tremendous flexibility. And if you have heard that these plans are starting to get a lot of play from accountants, or you're hearing about it, it's largely because of this flexibility that they see it as a wonderful tax control tool that can be moved year to year. Because I would venture to say, if I polled everybody in the room and said, do you think defined benefit pension plans are a fixed commitment for a number of years? How many would say yes? Okay, that was your father's old Oldsmobile. Okay, this is the new, goes up and down, and it can be a tremendous difference, okay? The other thing I wanted to point out on this slide is that the death benefit, you get both. So let's assume for a second that I'm funding toward a maximum benefit, which those numbers represented. A maximum benefit at age 62 or 65 is $225,000 a year, $18,750 a month, okay? The IRS says you better have close to $3 million, about $2.9 million in your sack of money if you're going to make that promise. That's the definition of fully funded. Well, let's say I'm real close to that and I still have a policy in the plan, and the policy is $1.8 million and it has a cash value of $300,000. And I grasp my chest, sorry for the noise, and I keel over. The trustee collects the $1.8 million. He strips off the $300,000 of cash value. He puts it with the other assets of the plan. They get rolled up and can be distributed to my named beneficiary as a rollover IRA, right? No tax. And the $1.5 million of net death benefit is paid out tax-free to my named beneficiary. So it gives us immediate liquidity, and it gives another tax-free benefit that can be taken out later in life. What keeps it tax-free, the net death benefit, is my reporting every year of the reportable economic benefit. Used to be called PS 58. Then they changed that to table 2001, or the lower term cost. We were talking about this at dinner last night. If you were in your mid-50s, the PS 58 cost would have been $13 a thousand or thereabouts. The table 2001 rate is going to be about $4, $4.50 a thousand. And the term rate's going to be about $1.50. So you're not reporting very much income. Okay, and by the way, if you take a distribution of the policy, that creates basis. So the other thing that is important on this slide is that the inclusion of life insurance in a defined benefit plan does not, I repeat, does not reduce your benefit. If I put in a plan with no insurance and I put in a plan with insurance and they both fund toward $225,000 a year benefit, 2.9 million lump sum, and I add life insurance to one of them, all that happens is I pay that little extra amount while I'm funding the insurance. Okay? It does not reduce the benefit. In a defined contribution plan, remember, where I can put a limited amount of money in, then that's what happens. It would reduce the amount that's available to go toward investing in life insurance stuff. Okay? All right. Coming around the bend. This was the fact set. We started out with 558.9 for Robert, and the deduction was zero because he was over the number because he was specified service business. And so he was about to pay $149,000 of taxes, but we were able to reduce his QBI to 280, well underneath the 321. We could have tailored it exactly to the 321.4, but this seemed more reasonable. That gives him a $56,000 deduction, which leaves only 224 of taxable income, on which he'll pay 42. And it's in addition to the pension contribution deduction, there's a savings of 106.9. So that's a very big play. You get both of those deductions. Now, I either have everybody totally confused or I have everybody totally informed, one of the two, because I haven't had even one question. Anyway, to kind of sum things up, he catches up on retirement. I can tell you, you catch up a lot faster when you're putting in 275,000 than when you're putting in 56,000. I'm very good at math. And the life insurance, like I say, it's not all the life insurance in the world, but the average policy in a fully funded plan is somewhere, if you're going to short pay it or you're going to use a whole life and take reduced paid up as a exit strategy, you're going to have about $1.8 million or $1.9 million death benefit. And it'll be heavy loaded cash value. So it gives you quite a bit of protection. And like I say, Uncle Sam pays his fair share. Not because it's life insurance, but because it's an integral part of the funding of the plan. And of course, we saved $106,898 in taxes. And it does allow Michael to buy the business. I guess one of the things that you have to look at is we do this a lot in planning where the owner, do you have any of these situations where the owner would like kids to buy the business or would like an employee to buy the business? And there's usually only like one problem. They don't have any money. I mean, other than that, it's perfect logic. And so what happens by doing this is it's a way to take a bunch of money out of the business on a tax deductible basis, therefore lowering the price that you would have to achieve for the business, for the fair market value of that business. And now it comes back into range. Okay, I'm gonna at this point take a little bit of a break and turn this back over to Stacy, and I will see you all in a little bit. Thanks.
We need a curtain. Go back behind the curtain. Mr. Oz. I want to go back to, I know how to go back here. Does anyone, I don't know if you remember, where does Robert live? Where is the orthopedic practice? Oklahoma, good job. Pretty reasonable cost of living standard there. He's probably living okay. He probably has a big ranch or something. But the one question I got, no one's asked this question. You're all, coffee kicking in. The 280, he's dropping his income down to 280. So you have to have that right client who's willing to do that. If they're not willing to live on less than their $558,000, then this is not going to be the best strategy, right? They have to be willing to drop that income. But keep in mind, where's that money? Is just not disappearing, right? That money is going into the qualified plan. The business is putting that's a contribution toward the defined benefit plan. It's not like he's missing out. It's going to he's being frugal. He's buddies with Warren Buffett, and he's living very frugally. So I just want to call that out. LA, doctor, orthopedic surgeon's probably not going to, just a stereotype, Los Angeles and California. You have to have that right client there. But Dr. Williams is very forward-looking. He's a saver. He wants to, have this great retirement, and he's doing okay with the 280 or 310 or whatever amount.
Stacy, can I also point out that wherever I said defined benefit plan, it could easily be also cash balance plan. Those are interchangeable in today's world.
Okay. Yes. There are different types of defined benefit plans. Cash balance is probably the one of the more
Yeah.
commonly used ones now. Yes. All right, we'll go back, skipping ahead. So we got our tax savings here of 106,000. And just to keep you on your toes, those items are bracketed for future changes. So presumably, taxes might change depending on any kind of tax changes, but that's for 2019. And again, our fluid case study, we're not sure if we're getting the business down to Dawn or part of the business down to Dawn. Maybe Michael does work in the business, from what I recall from our case study, so it could be passed down to. The point is, we don't want to have Robert relying on selling his shares to a third party to fund his retirement. He's a self-made man. He wants to fund his own retirement and not, what's my business going to be worth? Kathleen mentioned, those business valuations. Everyone is a little bit scared to do that. But a lot of business owners tend to, think their business is worth maybe a little bit more than it might end up being when it comes down to the actual sell time. All right, so just to talk about who is our ideal client, Robert fits squarely into this. We've got a round peg into a round hole, not a square peg into a round hole. We have to have a small business, could be a single employer. Typically, if you have too many employees, that's because we want to have an established business, but don't want too many employees. Robert has one key employee, which is excellent. We have a couple of co-owners who can be excluded, if I'm correct, Bruce, because they're considered highly compensated. So not to diss the siblings, but they have their own planner. We're taking care of Robert. He's 50 or older. Why is that important for our defined benefit plan? More what? If you have an older, if you're older, you're not only do you have more insurance, hopefully, like the movie, or you are, but you're also closer to retirement. So the Department of Labor looks at that and says, okay, you're older, you're 54, like Robert is, you only have 11 years to retirement, you can contribute more to your qualified plan, right? Defined contribution plan is just that. There's 56,000 allowed for employee and employer contributions in 2019. Defined benefit plan, if you're in your mid 50s, you're going to contribute 6 figures. Okay, so quite a difference there. So we're 50 or older. Can we do a qualified plan for someone younger? Yes. They're just not going to be able to put as much in. So a 31-year-old is not going to see a huge benefit doing this right now, although not a bad idea to get that going. They have a lot more years to save, but they're just not going to be able to put in the 6-figure numbers like we see here. 1 to 10 employees. Why do we look at that for our ideal client? Right. If you have 1 to 10 and more than 10 eligible employees, we have to start, it's non-discriminatory plan. We have to make sure we're contributing to all those participants as well. Steady or growing cash flow. We want to make sure that plan has, the business is profitable. We're able to make those contributions yearly. The defined benefit plan needs to be, in the Department of Labor's eyes, a permanent plan. This is not something where they can just fund it for 3 years or plan to fund it for only 3 years and then have it terminated. Department of Labor will not be happy with that. The rule of thumb is at least 5 years. That's what I've heard.
I mean, there's nothing written on a rock, but one of the things that's really interesting and that I try to point out is that there were a lot of plans adopted in 2007. I'm not sure, do anybody remember 2008? Oh, you do, okay. I suspect that some of those got terminated because the rule is, do I have a good business reason for terminating the plan? While there is a sense of permanence, but if I have a good business reason, I lost my major customer and not coming back, or something major occurred, that changes the game rather significantly.
Sure. Hopefully we are not going to have another 2008, but we'll see here. The kind of the 1 and the 10 employees kind of goes hand in hand with that making healthy contributions to an existing defined benefit plan. Robert and his orthopedic group, they do have a 401k plan. That's that $1 million of savings. Dawn has as a participant in that. If you have an existing defined contribution plan where the business is already making pretty healthy contributions to that plan for the owner and as well as all the eligible employees / participants, that's going to allow you to have a few more employees. Okay, so don't think, okay, all my business owner clients, thank you, have, if I have 11 employees, it's not going to work. Run the census. Call Bruce, your TPA specialist, but Bruce is very willing to answer questions. Anytime, you can don't all call at the same time, but he's a great wealth of information for us. They can run a census really quickly and find out if it's going to work for a particular client. All right, a couple charts here just to kind of compare, because Robert was looking at, okay, I already have this defined contribution plan. What's so great about this defined benefit plan, Stacy and team of speakers here at Level Up? When we look at the maximum annual contribution amount, so we're dropping his age down to 53, just to see what, we have an extra year. Still going to retire at age 62, but we've got an extra year to save. So it'll bring those numbers down a little bit. And a profit sharing plan, recall that we're only putting in $56,000 a year per person maximum, right, with employee and employer contributions for 2019. With the split funded, we're getting about, at age 53, we're getting about $229. And that extra with the life insurance, the light blue color there, so we're able to add another $43,000 for a 53-year-old making X amount of dollars. Any idea on how much of that? So we had 273 total there for this particular age, 53-year-old. Remember, Robert was closer about 278. How much of that are we going to be using for premiums? Okay, the people in the front, don't cheat. You can see it there. But how much of that contribution, the 273, are we going to get putting toward the life insurance premiums? It could be a ballpark. Any idea? I mean, sorry. Close. Yeah. I mean, the maximum is 50% for putting a whole life policy in there. In this case study, we're only putting 114. Be really conservative. The death benefit has to be incidental to the plan. Okay. So there are limits on how much of that contribution to the plan can go into premiums. But being very pretty frugal and conservative, we're only putting 114 in, so less than that 50%. We're paying those premiums over 6 years, and we got 1.8 million death benefit. So we'll see how that impacts everything in another slide here. But I just want to compare, and the profit sharing, you'll notice with life insurance, does that increase the contribution amount?
No. No,
right? So this is with life insurance. But just the profit sharing plan does not change the contribution amount. Okay, and we will get all these slides to you all. I don't know if you're aware of that. We'll make sure we get these slides to you and any other additional materials. Certainly Pacific Life prides themselves on as many marketing materials as we can churn out every year. Now looking at the total retirement savings. Thank you. Am I going till 9:15? 9:15, okay. All right. When we look at this is over, we've got our 10-year span here. Robert starting out at 53 instead of 54, going to age 62. We had about 813,000 saved up in the defined contribution plan, our profit sharing plan, because we're limited, right, by those contribution amounts, which do go up incrementally, teeny, tiny little amounts every year. The defined benefit plan, again, it's based on age. How much are we going to receive if someone's retiring in 2019? Anyone know the number for a defined benefit plan? What's the maximum benefit? 225,000 per year. Okay, that's the maximum benefit. So we work backwards from that. The closer you are to retirement, actually you can contribute more than 225 because you're backing into the number. What's going to end up being the total amount that they can get when they retire. So our defined benefit plan, this is just without life insurance. Okay, this is just the plan. We're getting close to 2.8 million saved in 10 years for Robert. So Robert's liking the sound of this. Like, okay, well, 800,000 versus 2.8 million. That sounds good. I'm going to drop my taxable income down, but look what I'm getting when I retire. He's not going to be dependent on selling that business. How many of your business owners are looking to possibly sell their business as a major source of retirement? you know, a lot, yeah, it's a good plan if it works out, right? So we just try to show the numbers and say, you know, here's a kind of self-funded plan here. You don't have to rely on some great third party coming along or my key executive sticking with me. You know, Dawn's a bookkeeper. Maybe she's going to learn the ropes and become an operations expert as well, or become a surgeon as well in our example. But got to make sure that we're not, you know, not just hanging our hat on something that may not be there. And our life insurance additional to the defined benefit plan. Now we're just looking at the defined benefit plan. This is where the Pension Protection Act says, hey, we can have life insurance in a defined benefit plan, in some kind of qualified plan, to make sure the survivors are covered. Let's say I start a qualified plan like Robert. I pass away next year. I haven't had time to put anything into the plan, right? Even if I can put in $200,000 a year, that's $200,000. With the death benefit, with our premiums here, $114,000 a year times 10 years, day one, right? That death benefit coverage is going to be there. And in this case, it's a 1.8 million death benefit. So we're adding 1.8 million to the light blue line to get the purple line. So day one, age 53, my family is going to get about 2 million instead of that 200,000. Age 62, about that normal retirement age. And this is all assuming that the life insurance is still inside the plan. And Bruce talked about the idea of the survivor benefit. You know, part of it's going to be taxable unless they roll it over to an IRA. The death benefit, most of it will be income tax free. So we've got, you know, over 3 million, 3.5 million there for age 62, and upwards closer to 5 million. Now, certainly not a, you know, if someone's working to age 75, they've still got 3 million plus just in the, without the life insurance there. But 5 million to take care of the family is going to ring a little bit, sound a bit better than that 3 million. So we always talk about, you know, let's add the life insurance, get those contribution levels up. And what we see often is, can we take the life insurance policy out of the plan? We don't have to leave it in there, right, till retirement. We can pull that policy out probably about the time the premiums are quote unquote paid up, and we want to get that policy distributed after 59.5, so we don't have to pay the early distribution tax or penalty that will be taxable income to them. But we want to get that policy over before the cash value starts zooming too high up. All right. Any questions on the comparison there? You guys are fast learners. I'm going to turn it back over to Bruce to tackle all the possible questions your business owner clients and their employees might have.
Thank you.
Thank you, Bruce.
Well, we talked about, are there any costs to the insured along the way? And that's that reportable economic benefit, which, you know, to an owner who's putting $250,000 in a plan and reporting $3,000 of, you know, reportable economic benefit to keep the life insurance tax-free doesn't sound like a very big hit. So, and then what are the other options at retirement? Obviously, you can leave the money in the plan. If there's somebody going to be operating the plan, you can get your benefits paid out of there. You can terminate that plan and roll it into the profit sharing plan that they have. You can terminate the plan and roll it into an IRA. And if the insurance is still in the plan, if you haven't bought it out, by the way, there's a prohibited transaction exemption that specifically permits the participant to buy the policy from the plan, and he can deal with the plan, and it is not a prohibited transaction. It's numbered 92-6. So, but if he hasn't done any of those things, you could distribute the life insurance to the participant, and you know all the economic benefits that he paid, they become basis. So if it had a $200,000 value and he had reported $50,000 over the years, he would have taxes on $150,000. So you could do it that way. And he could pay the taxes out of personal funds, or he could make a loan from the policy to pay the tax. All the same. Okay. Buying the policy from the plan is the most efficient way if you're going to get it out and you want to use it as a supplement to the pension plan. See, if I buy it out, I now have a couple of things. One, I buy it out for its fair market value. There's no taxation. I put in cash and I take out a policy that has valued at cash value. So it's trading cash for cash value. It's a wash. There's no tax. But now I own the policy. So what happens is I used to have one tax deferred account, the pension, and one taxable account, my money market fund, if you will. When I put that money in and pull the policy out, I now have two tax deferred accounts. Well, when I did that transaction, I used to have one tax asset protected account, one totally asset protected account, the pension, and the money market fund was totally exposed. When I pull the policy out, I now have two, depending on the state, totally asset protected assets. That's pretty important. What else can I answer for you?
Bruce, I think this one's for you. Can you elaborate a little bit more on the QBI limitation for S-Corp if taking reasonable compensation?
Yeah, okay. Yeah, the question is about S-Corp reasonable compensation. There's a record number of audits of S-Corps going on, and it's as a result of a gentleman that you may have heard of. I think his name was John Edwards. He ran for president and he made the newspaper on a number of other topics. But I believe what happened with Mr. Edwards is he was a personal injury lawyer and he had a very high income one year and he took out zero compensation, zero W-2 wages, and $26 million of K-1 dividends. Now, K-1 dividends are supposed to represent return on capital invested. And W-2 wages is supposed to represent what you worked for. I have suspicion they took exception. So anyway, that said, they watch for that. Where it really becomes important is if you're a non-service business. If I'm a partnership or a W-2, I'm a partnership or a sole proprietor, I don't get W-2 wages. So if I am a non-service business, remember that wage and capital testing? What are my wages? They're zero. So I'm going to compare 20% of QBI to zero, 50% of zero. So a lot of what I mentioned early on is that entity planning may require that non-service business to reform itself as an S-Corp or to be taxed as an S-Corp so they could get some W-2 wages. I know I'm getting close on.
Yeah. Could you repeat again and clarify when you made the comment, and I think it was Stacy, on architects and engineers as service businesses, are they excluded or included, and are they eligible for the 20% deduction rather?
I'm sorry, I could not hear the question.
Are engineers eligible for the 20% deduction?
Yes, they are, but they are a non-service business. Okay, so once they cross the 321.4 threshold, they go into the wage and capital testing.
Could you clarify this? Is this the case or not? Split-funded defined benefit plans can be offered whether a client has a 401k, simple or not. Can it be a plan in lieu of offering one of those plans?
Okay, 401k, yes. Simple, no. Simple is a problem because a simple, by definition, in the body of the document, it says this is the only plan of the employer. If you were to adopt another plan, you would invalidate the simple and lose all the deduction. So you must terminate it the next year and then go into it. To terminate a simple plan for January of 2020, you need to do the termination by November 2nd of 2019. Thank you all. Our time has run, and I was told one time to be on point, to be brief, and then to be seated.
Bruce,
Thank you.
Stacy,
Have a
thank you
good
very
day.
much.
Good job.
We're going to go ahead and start our 15-minute break. Please come back at 9:30 sharp or perhaps a couple minutes before that. Thank you. Let me go ahead and introduce Andrew Wren, our next speaker. As the Vice President of Advanced Markets and Practice Management at the Emeritus Company, Andrew leads 2 teams of credentialed individuals that bring cutting-edge and distinct financial solutions to today's advisors. His team provides training that covers the full spectrum of training from newly licensed agents to sophisticated advisors seeking to present smart solutions to their best clients. Once again, let me introduce Andrew Wren to the stage.
Good morning. Hey, all right, start again. A lot in a short period of time. So we are going to probably be running this out here with the next hour and a half, 2 hours. So what we'd like to go ahead and do, oh my God, that's a far younger version of me. So, you got to hold on to those pictures sometimes. So what we're going to do is go ahead and spend a little time talking about business succession and buy-sell planning. And what I'd like to do, if at all possible, as most of the speakers have done so far, is to try to get some questions and some interaction going with you all in the audience here. Sound fair? All right. Show of hands, be honest with me. Who actually read the fact pattern? Just be honest, because I'll know. All right. All right, let's reverse it. Who did not read the fact pattern? All right, okay. So I could pretty much tell you anything at this point, right? So that gives me a lot of liberty. All right, so we're going to be focusing on a specific technique, and of all the things that we've talked about so far, this might be the most focused as far as a strategy or technique or an idea per se. And what I want to do, of course, is use the example from our case study. So we have Robert, Nicole, and Sean. For those of you that did read the case study, just think about Robert and Nicole and Sean. What's the main issue you see right off when you think of those 3 individuals that are 1/3 owners of orthopedic practice? What just springs off the page at you? Right, one person's not involved. Nicole doesn't seem to be very involved. I think that's one. Anybody else? Yeah, Sean, right? I forget how old he is. He's 61, a little bit older. He might need a double knee replacement surgery at the very least, right? So we have 3 individuals. What stuck out at me is the disparity of ages. So we have Nicole 40, Robert 54, and Sean 61. And often for those of you that have done business succession, buy-sell arrangements, you know what, that's not unusual. Dealing with that disparity of ages when you're figuring out the best way to structure a buy-sell, it's a big deal. So that's one of the things this strategy, what I call the buy-sell LLC, is meant to help, not completely remedy, but to help that a little bit, all right? So let's go ahead and kind of review what I think are the 3 wants. Number 1, buy-sell liquidity needs. What if one of the siblings passes away? What if something happens? What do we do? Because we have a fairly large business here. We have Robert. He's concerned about his own retirement. How do I set aside relatively large amounts of money in a short period of time? Stacy and Bruce talked about that a little bit as well. I have another solution, not a different one, but maybe one that's additive in nature. And then what I love here in the fact pattern is it sounds like they're already sold on the idea of life insurance. They just got to figure out the best way to structure it, all right? I think we could help them with that, don't you? All right, so that's what we're going to work on. So saving for retirement, buy-sell needs, how to structure the life insurance. The buy-sell LLC that we're going to go through is meant to go ahead and try to figure out how that little conundrum is going to go ahead and work. All right, so let's go ahead and do that and see the most nervous part for every presentation is to see if this thing actually works. Yes, all right, pressure's off here. So will the buy-sell work for Robert, Nicole, and Sean? And help out the speaker here, all right? How many of you have heard about utilizing an LLC for buy-sell planning? I'm not going to ask any questions, just heard of the general idea. Of course, all the speakers raised their hand. You guys don't count. All right, so good. And LLCs are becoming, as we all know, more and more prevalent. That's because they're very flexible. And I think you'll see and understand the flexibility very soon here. All right, so with that being said, I'm going to do a little bit of a prelude, then I'll kind of delve into the presentation itself. So, all right, so we're going to keep this fun and relatively easy, but I'm going to make you answer a couple of questions. All right, start out easy. Who's heard of a cross-purchase agreement? Right? All right. Do we have a brave soul, Kathleen? Do we have a brave soul that could high level just tell me how a cross purchase works? Did I say this? One up here? Yep. Front row. Surviving owners buy the business. Surviving owners buy the business. So you and I purchase life insurance on one another. You pass away, because I'm the speaker and I have to kick you off first, right? I use those proceeds on the life insurance that's on you to buy out your business interest from your estate or your spouse. That's correct. That's cross purchase. Well, Stephen, do you want to hit entity purchase for us then? Yeah.
Entity purchase would be if us three all owned a business together, the entity would own policies on each one of us,
Right.
as opposed to us each owning a policy on the others.
Right. So perfect. We got some ringers right in the front of the room here. So the business is owner, beneficiary, and premium payer, as opposed to the individual owners themselves. All right, that's baseline. We're going to up the game a little bit here. What's a potential structural issue with a cross-purchase agreement? Number of owners, number of policies, both are correct answers. Can you describe what you mean by that a little bit more so the rest of the audience knows? Let's say you have 3 owners. What's the problem with that? N times N minus 1, that's right. So you get 6 policies because you each have to go ahead and insure one another for your proportionate interest in the business. You know what? It just gets unwieldy after a while if you have too many owners, if you want to utilize a cross-purchase agreement. So that's potentially an issue with that, right? Is that fair to say? Okay, an entity agreement that Stephen, you were just talking about. And if you have a question, just hold on just a half a second. You got the entity as the owner, the beneficiary, the premium payer. And you could do that with an LLC or an S Corp or whatever the case might be. That works fine. You kind of write the corporate check. There's some simplicity in that. And to a certain degree, you kind of mitigate the disparity of ages like we have in our fact scenario here a little bit. What can be a problem or an issue with an entity or what some people call a redemption agreement? Stephen. Who agrees with Stephen? If you have an entity agreement, you might not get a step up in basis. That's right. It's mostly right. It's mostly right. It depends on the type of entity that you're looking at. The easy example is the C Corp, where if that's structured as a redemption agreement and one of the insureds passes away, you're not going to get a step up in basis. With an S Corp, depending on the type of S Corp, you'll get a limited basis step up. And we'll see with the LLC, if you structure it just perfectly, you can get a full step up, all right? So we're just kind of laying the groundwork a little bit here. Can I step off the stage here? Because I really hate standing up here. Will this work? Is this better? All right. Can I pull 3 of you into my tangled fact scenario web here? All right. So we have Robert, we have Sean, and we have Nicole. So I want some actors here that could kind of fill those roles here, all right? So, God, so Joanna, we were talking before. Periwinkle, is that close? Was that kind of an off blue suit? I really like that. That's good. Would you go ahead and play the role of Nicole in our fact scenario? Thank you very much. So Joanna, and then who else do we want to pick on a little bit? We got Joanna and Paul. Paul, you look like you could almost be, I don't know, do you want to be Robert or do you want to be Sean and you need double knee replacement surgery? What do you want to be here? You actually need one? Okay. Well, you're Sean anyways. So, all right. So we got Paul, we got Joanna, and let's see. Stephen, I'm gonna pull you back in just because you volunteered first, and you know, that's what happens to people that sit in the front. So Stephen, Paul, Joanna, so you're the three business owners. And so let's see if we can make this as real as possible for you. So, you know, we got issues with an individual that's a little bit older, right? That's Sean. We got Robert that's right in the middle in the 50s. So we got that going on. That we have Nicole that's significantly younger, about 41. With a cross-purchase agreement, one issue you run into when you have that great disparity of ages between the three of you is you have to subsidize each other's life insurance policy. And who wants to do that? Very few people. Very few, especially for Paul. My God, right? So, you know, who wants to do that? So entity agreement sometimes is a solution to that. So you get these two schools of thought with these two types of different structures. And what do? One answer might be in the proper circumstances, utilizing an LLC. This doesn't resolve all the problems, but it certainly mitigates them. It can mitigate the disparity of premium issue. It can mitigate the issue with step up and basis. And one thing I haven't really addressed, remember that third thing that Robert wanted? It could also provide a means for retirement. I don't know about you, but a pushback that I often get in business owner situations is, you know what, I'm just going to go ahead and just get, you know, 3 or 4 term policies on everybody and call it good. It's hard to rebut that sometimes. But if I could show you a way where we can go ahead and mitigate, if not eliminate, a lot of these issues with age disparities and premium problems and basis issues, but also use a funding vehicle for your retirement needs if you don't need it for buy-sell. Now, are you interested? Most people say, yeah, I want to hear a little bit more about that. So that's what this buy-sell LLC does as well, provides retirement income. All right, so just like Stacy and Bruce were talking about the client profile for DB plans, there's a certain client profile for the buy-sell LLC. Not for everyone. You could do it for 2 owners if you want, it works, but it has the most power if you have 3 or more owners. Typically, you're going to want a partnership or an LLC that's taxed like a partnership. I'll explain why in a moment. You want that LLC to be the owner, beneficiary, and premium payer. So this is walking and talking like an entity agreement, this buy-sell LLC idea so far, right? 3 or more owners. You want something to address the latent transfer for value issues. So back to a cross-purchase agreement and some forms of entity agreements. If you have somebody pass away, you might run into a potential transfer for value issue. Owners, entity is going to go ahead and control. So you want a clientele that wants the business to be the center of control. Control makes a big difference for a lot of business owners. Kathleen was talking about endorsement split dollar, and you were discerning between the sort of candidates that you would be looking at. Endorsement might work for owners that like control. Buy-sell LLC works for owners that like to be able to control the underlying life insurance. You want to get the basis step up. You want to be able to repurpose those assets, in this case, life insurance for retirement, and liquidity for transfer taxes. Yes, transfer taxes are still out there. And so I'm going to break down how this is going to work. Then we'll pause for breath, see if there's questions. Fair enough? All right. So let's go ahead and do that. So, and I'm overly complicating it just a little bit just to make a point here. So you're going to have the LLC, which is going to be taking money from the owners. Where's the owner money going to come from? You can make a capital contribution if you're one of the three owners here. So if you're Joanna or Stephen or Paul, you can go ahead and make capital contributions to the LLC to pay for the life insurance. Remember, the LLC is going to be owner, beneficiary, and premium payer. So policies are going to be taken out on the three of you. You're establishing something called basis by so doing, by making capital contributions to the LLC here. If it's a pre-existing LLC, this becomes real easy. If it's a new LLC that you're putting together for this purpose, there's a school of thought that says you might need another business purpose besides the transfer of the business itself, besides it holding life insurance. At retirement or death, you have two things happen. You retire. I'll talk very shortly how those life insurance policies can be reobtained, how they can come back. And we'll talk about in the case of death, if somebody passes away, we got to figure out which of you three we're going to kick off. All right, I'll talk about how that's going to work as well. All right. All right, before we get to the death time scenario, that's my favorite one. All right. So we got our three volunteers here. So we got Paul, we got Steve, we got Joanna. Do you guys know who these three individuals are? Like if I wanted to kick one of them off first for purposes of an example, I mean, who should go first? Who should exit the stage? Paul, maybe? Steve? All right. I'll figure it out myself to see which one. See if you keep up with us still. All right. So premium inequity, that was the first issue that I brought up a few moments ago. The advantage of using an LLC where you have somebody that's 41 or 54 or 60 some, it's a lot easier to deal with that premium misproportion, if you will, that you go ahead and have. I mentioned making capital contributions to the LLC. So the money has to go in there, obviously, so the insureds are in effect self-funding their own buy-sell. But once they're in the LLC, you can allocate those monies, those capital contributions, however you want, as long as there's something called economic substance. That's not the case with an S Corp. With a C Corp, it's very difficult. With an LLC, I'm not going to say they're a little bit more loosey-goosey, but there's a lot more flexibility in how to utilize the monies once they go into the LLC. So you can allocate those monies going into the LLC, even if there's a disparity of ages, according to the partner's capital accounts, and specifically for the life insurance policies themselves. All right, so I'm going to hit an exit, then I'll talk about death next. So let's say, Stephen, you're Robert in this particular case. You want to go ahead and leave the business at some point in time. Nobody's died yet. So Nicole, you're doing just wonderful. And Sean, in spite of your knee issue, you're still doing just fine as well. So we want to go ahead and have Robert exit the business. What I like best about this particular technique is there's an opportunity to reobtain ownership of your own life insurance policy for very little, or in some cases, no income tax at all. I'm back up just a bit just to make a point. It always seems to happen on a Friday. Often I get phone calls and it's, Andrew, I got this S corporation and they own all these life insurance policies. And by the way, my tea time's in 10 minutes. They want to get the policies out of the S Corp and back to the insureds. I'm assuming since they're the insureds, there's not a tax issue. I just need to hear that from you. And we're fine, right? And it always happens about the same time on a Friday. And the answer is no. We have some huge freaking issues there. When you try to pull life insurance out of an entity like an S Corp or a C Corp, I don't care if we're transferring the policy to the insured. I don't care if there's no transfer value issues, because that's an exception for transfer for value. That's a taxable transaction. That's what we call a Section 83 transaction. We transfer a life insurance policy, which is property for tax purposes, to the insured. more or less that cash value, the fair market value, that's going to be subject to income taxation. And if it's from an S Corp, it gets even better because your fellow shareholders are really going to love you because they're going to be taxed on the equity in that life insurance contract according to their prorated interest in the policy. S Corps make awesome vehicles to do lots of cool things with. And if I have time, I'll give you another sales idea with S Corps. They're very difficult for entity planning. They're very difficult for buy-sell planning if you want to get those life insurance policies back again. LLCs, much better. Why? And there's only a few code provisions we're throwing at you here today. I do want you to go ahead and jot this one down if you could. 731A. 731A. What that allows you to do is transfer property from a partnership or an LLC that's taxed as a partnership. Essentially tax-free, it's a return of basis. So if you are a member in an LLC, in this particular case, Steve, you're exiting the business, you can get your well-funded permanent life insurance policy back tax-free. You're using essentially, corporate money to fund it. This is your retirement planning vehicle. Because the way you got to look upon this is, this is an advanced markets presentation. You're going to be dealing with business owners that probably capped out their traditional qualified plans for whatever purpose. Maybe they're progressive in doing a split funded DB or 412E3. That's awesome. Let's give them another vehicle to go ahead and get some equity and some business value out of their LLC. Use their own life insurance policies, which they were using for buy-sell purposes, and use them to supplement their retirement. Pull those policies out of the LLC. 731A lets you do that for little or in some cases no tax at all. Can't do that with an S Corp. Can't do that with a C Corp. Only an LLC or a partnership. That is huge. When you're dealing with CPAs, attorneys, centers of influence, most of them, Kathleen could back me up here, have a high IQ when it comes to LLCs and partnerships, but that IQ goes down a little bit when it comes to how to structure life insurance and financial products. That's what we're here for, to help them in that process. We could bring some of these techniques, these sales ideas to the table, which even those centers of influence aren't necessarily going to know. All right, I'm hearing some feedback. Can you hear me still? All right. I'm going to hit the death scenario, then I'm going to pause for a little bit. What if somebody passes away? So, Joanna, we're going to actually kick you off, okay? So Nicole's dead, all right? All right, she is dead. So you can speak from the grave if you want. That's perfectly okay. We'll let you do that. She's dead. What was this? This was an entity agreement, wasn't it, Stephen? So where do those proceeds go to if Nicole passes away? Into the entity, into the company. If it is not an LLC, let's say it's a C Corp, do you get a basis step up? Yes or no? Do you get a basis step up if it was a C Corp and not an LLC like I'm talking about? I'm telegraphing here. Right, correct, no. Because with most C Corps, you're simply the way the basis rules work, you're not going to get a basis step up. But with an LLC, what we can go ahead and do is we can make a special allocation to Paul and Stephen. So you're dead. You're out of the picture here. The full amount of those proceeds, I think the business is worth like $9 million. Let's say it's $3 million for your 1/3 interest. The full amount of those $3 million of proceeds could be used to step up the basis of the survivors. All right. So we will get a basis step up. It works a little bit different than a cross purchase agreement where my basis step up is going to be equal to the purchase price. Here it's a little reversed where we have the proceeds paying into the entity and the basis is being stepped up with the life insurance proceeds. LLCs, very effective. You can get the policies back out with low taxes, in some cases no taxes, and you'll still get a basis step up, even though it's an entity agreement. So when I asked the question earlier, do you get a basis step up with an entity agreement? Yeah, sometimes you actually do. You will with an LLC if you do it right. That fundamental bit of knowledge that we've shared here today is not known by 9 out of 10 CPAs and attorneys when it comes to how to structure life insurance and how you'll get that basis step up. That's a nugget. I hope that you use it. And I don't want to advertise too much for my own company, but somebody already did that earlier without me even asking them. If you are looking for white papers or pieces to describe the technique, we could certainly help you out with that as well. All right, that's as much as I'm going to say on that. All right, before I go actually into benefits and considerations and one or two other sales ideas that I had to kind of smooth things out here, are there any basic questions with the buy-sell LLC technique? How it works, how it's structured, what it's meant to do? Yes.
Suppose you have an existing S corp. How do you get them out of the S corp to get to the LLC, or is that even possible?
I was hoping nobody's going to ask that question. So that's actually a very excellent, astute question. And I said I kind of overly complicated it in a way, but thanks for recomplicating it. So what you do, let's say you have an S corp. You have a pre-existing S corp, and we got our same 3 owners. It's a little less easy, but not overly difficult. They had the pro rata rules, which apply to S corps. So they could only take out of the S corp what their pro rata interest in the S corp already is. So you take money out of the S corp, you make those contributions into the LLC, which will buy the life insurance. Once it's in the LLC, then you have all the flexibility you want. Awesome question. Was there another one around here somewhere?
Yeah, I had a question. The cross purchase is real obvious because she has to pay more for somebody else's policy. But if you look at the entity, isn't it the same way? I mean, to bonus those out, the younger guys say, wait a minute, you're getting a bonus the same as I am. So it really is the same thing. It just looks different. You're just kind of somehow disguising it. At least that's how people I presented it to say. And then the second thing
Yep.
I'll address is there an exclusion for UBTI if that insurance proceeds come into the LLC?
Okay. Regarding your first question, I can answer that one. The second one, I'm gonna have to go ahead and think about while I'm figuring out the first one here. So the first, this is an entity agreement, this buy-sell LLC. So from a age disparity premium check perspective, it's not different than any other entity agreement. So that part's indeed the same. What makes this a little bit different is because we are using an LLC and not another type of entity, you can get those life insurance policies back out for a lot less than they would if they were an S corp or a C corp. Okay, I think that answers the first one. The second one, give that to me one more time.
Unrelated
Business.
taxable income.
Yep.
Insurance proceeds, if this is a doctor's office, their income comes from fees, not life insurance proceeds.
Mm-hmm.
So would the IRS consider that as taxable income that comes into the corporation?
No.
The LLC?
No, otherwise you would invalidate almost every redemption agreement that's out there that utilizes life insurance. Those death proceeds are not considered to be unrelated business income in any way, shape, or form. You should be perfectly okay with that. Yes, sir. Insurability.
If one's uninsurable, how
Yep.
do we work that?
Yep, that's potential. And Paul, you did have the knee issues, so that's you could potentially be uninsurable. Same answer that I usually give you for if somebody's uninsurable, they're uninsurable. So maybe you would establish some sort of sinking fund to take care of the uninsurable person. There's no magic bullet or magic answer for that. There's potentially some situations where, and you got to be careful here, maybe you could take out a little more life insurance on the healthy individuals to provide more cash for potential buyout to help to subsidize that sinking fund, but sinking fund's still going to be the same answer. Yes?
You mentioned that the LLC, if new, requires a second business purpose. What are some examples where this would qualify?
Well, going back to the S Corp situation, if you do need a business purpose, maybe you do a lease back arrangement between the LLC and the S Corp for like rental property. That'd be a very simple business purpose. So if you had a very conservative attorney and felt like you had to establish that, maybe you do something like that. Anything that would otherwise make an LLC legitimate is going to be a business purpose. Okay. Anything else before I throw out a bonus idea? All right. All right, moderators, how are we doing on time here? Okay, beautiful. All right, works out beautifully. So you get the buy sell LLC idea, I hope. So utilize it, leverage it. It's a great technique. And Kathleen, I want to go back to something that you talked about earlier when you were giving your enticing talk about endorsement split dollar versus loan regime. And I was listening to you and I was thinking to myself, Dawn was the key employee that we were talking about. She's the one that kind of lived in Wonderland that could be either 31 or 49. All right. So let's go back to Dawn for a moment. Kind of according to the fact pattern, she's expressed some interest in obtaining some ownership. And it was kind of vague with the fact pattern, but let's address her for just a moment. Let's say we wanted to go ahead and give her an ownership interest in the orthopedic practice. How do you give somebody an ownership in a business that has very shallow pockets, right? Isn't that the issue with a lot of these business owners, is they have the key employees of the world, but these key employees don't have the assets to buy them out. One potential solution might be along the following, and this is still a buy-sell idea, so it kind of falls under my allotted talking time, so I'm allowed to talk about it. But I'm going to mix in a little bit of split dollar. All right, so let's say with Dawn, so I got a glare here. Is it Tally? Would you mind being Dawn? So you're the 31-year-old version, right, of Dawn? Okay, good. All right. So you're my 31-year-old high-powered bookkeeper, all right? Just keeping all the numbers straight. Well, I'm just taking out the fact pattern, unfortunately. I want to keep you around for at least the next 20 years till you're 51 and ready to go ahead and retire. But at the very least, if you've expressed interest in obtaining this business, at some point in time, maybe going from being my bookkeeper to being an owner, can we work out an arrangement where I can put a golden handcuff on you and also provide an ownership buyout situation? The answer might be the following. And I was a marketing major before I became an attorney, so I'm gonna throw out a phrase like buy sell LLC. That doesn't mean anything other than something that Andrew kind of made up as a name, all right? Same with this next one. I call the dual executive reward, the dual executive reward. It's tying in split dollar with a buyout for Tally in this case, all right? So let's say we have 20 years to go, and at that point in time, I'm thinking of transferring ownership over to you. How can we do that? Well, why don't you and I enter into an endorsement split dollar agreement? And as Kathleen mentioned, who's the owner in an endorsement arrangement? The company. That's exactly right. So I have the power, I have the control. So we're falling into that category, all right? You and I are entering an endorsement arrangement, and if you die between now and the next 20 years, I'm gonna get the greater the cash value for the premiums paid, all right? Just like we were talking about earlier. So a plain endorsement arrangement. That's my golden handcuff because you're my key executive here. Let's up the game just a little bit because we get that now from what Kathleen mentioned earlier. We get how endorsement works. What if we arranged it in such a way where I promised a future lump sum to you as part of this endorsement split dollar agreement that would allow you to obtain an equity interest in my orthopedic practice? Because that's what you really want, all right? All right? How can we do that for Tally? Well, we could do it the following way. Tally and I enter into an endorsement split dollar agreement. We have a separate agreement whereby I promise her a future lump sum in 20 years. That lump sum is going to be funded by the permanent cash value of that life insurance contract. Now, if I'm in your seats and I have any background in 409A or deferred comp. What did I say that might scare you just a little bit right now? If you make a promise of a future lump sum to somebody, generally that's a promise of future compensation, and that comes under all the rules, restrictions, potential penalties of 409A. And we're not down on 409A, non-qualified deferred comp today, because it definitely has its use, but it's more costly. Sometimes you have to have a TPA, and a lot of employers just don't want to mess with it. So with this dual executive reward idea, we'll do the endorse and split dollar. I'll do a promise of a future lump sum. Drum roll. This is the takeaway for you. If you structure it correctly with the dual executive reward idea, it goes around, there's an exemption within 409A. So it bypasses the rules and restrictions of 409A. All right, this is as geeky as I'm going to get today, I promise. It's called the short-term deferral exception, short-term deferral exception. I'll give you tax talk, and I'll translate that to real English in just a moment, okay? So we use the 20-year example. So if I promise 20-year lump sum bonus of, how much should I give to you in 20 years? My God, dealing with me, you want $1 million? That completely blows my example. Okay, that's all right. $1 million. All right. So I'm gonna have to jury rig my example a little bit. So let's say the death benefit's $3 million, and we project the cash value to be $1 million in 20 years, and that's gonna give you an equity interest in my orthopedic practice. This is the key to this concept. As long as I bonus that $1 million out within 2.5 months after the end of the taxable year, that tally vest in that promise is exempt from 409A. I'll translate that for you, I promise. All right, so we're looking at a lump sum bonus. We just chose 20 years. It could be 10 years. It could be 15 years. We chose 20. As long as that promise, that lump sum is paid out within 2.5 months, so let's say by March 15th of the 21st year, that's completely exempt from 409A. This is not a small deal. You can get around the rules and restrictions and headaches of traditional deferred comp as governed by 409A by taking advantage of this quirky little exception within the rules called the short-term deferral exception. That lump sum could be used to buy, because we could have a one-way buy-sell agreement, an equity interest in my business. Again, this whole meeting, everything that we're talking about here, from Stacy and Bruce and Kathleen, we're all trying to put together sales ideas that will give you a competitive advantage. Is this a niche idea? Absolutely. Can it be very profitable? Can it give you a leg up on what everybody else is talking about? I have to think that it would. So that's kind of the one-off sales idea that kind of falls into buy-sell planning. Was there a question?
So here's a question from from Craig Adamson. If you have multiple partners, but only one partner wants to participate in a defined benefit or deferred comp plan, can they do that? Or is it a Three Musketeers situation where all for one and one for all?
Yeah, and those are two separate deals entirely. And I'll defer to Bruce if I need to, but if it's a defined benefit plan, those are covered by ERISA, so you have to cover all eligible employees. Deferred comp, which was the other part of the question, the whole nature of deferred comp is you could discriminate on a permissible basis for highly compensated employees. So those are almost two different questions. DBs, you really can't discriminate. That's why you have to have the census just right for it to be perfect for the owners. For non-qualified deferred comp, please discriminate. You know, that's the whole idea, is you want to be able to partition them out. It's a great question. All right. With that being said, if there are no other questions, Buy-Sell LLC, love LLCs, 3 or more owners, step up in basis, pull the policies back out for retirement, tax-free, or at least low tax. Bonus sales idea, that DER, works really well in one-way buy-sell situations. And it's a good practical way to go ahead and tie in endorsement split dollar to a key employee that wants to stay vested in your business going forward. All right. Thank you for the volunteers here today and appreciate your time. I'm going to hand the baton over to you, Rob, and you're introduce our next speaker, Ron.
Yes.
Okay.
Thank you.
Thank you very much.
Andrew. Thank you again, Andrew. So as we walked through the morning, we talked about retaining key people. We had the opportunity to work with owners on how to accumulate more wealth outside the business. Andrew, of course, talking about the buy-sell and the kind of oh-no plan, that continuity piece, as well as an opportunity to go ahead and get value out of the business without a death event. We haven't addressed the estate planning yet, so we'll have Ron Lee speak to that. Let me introduce Ron a little more formally. He heads the Advanced Markets and Brokerage Field Relations Department at Mutual of Omaha. He's been with Mutual of Omaha 18 years. He stays active in the industry through his involvement with the Society of Financial Services Professionals, the Association for Advanced Life Underwriting, and his local estate planning council. Ron will be speaking again on the topic of estate planning for small business owners. Ron Lee.
Thanks, Rob. Thanks. Okay, here's where I'm going to differ from Andrew. I'm not coming down there because if I can be 6'2" or 6'3" for a day, I'm absolutely going to take that. So, yep, look on up. This is great. All right. So here's what we're going to do today. We're just going to talk a little bit about the estate planning needs of these folks. And obviously, we could spend a whole lot of time on that, right? There were a lot of issues in here. But we really can't do that. We can't take a whole day on it. So what I would like to do is I'm going to start with just a little audience participation. So if you just raise your hand if you have any business owner clients. Okay. Almost everybody. Now raise your hand if you have business owner clients with more than $11 million in assets. Yeah, many less, right? Okay, how many of you have clients that need a will? Okay, everybody's hands ought to be up. How many of you have clients that really need to have an incomplete or complete non-grantor trust? A couple, all right, I like it, good. So here's the thing. What I tried to show there is that we have clients every day who are business owners, and we can't always just jump to the triple Lindy off the high board type of concept, right? We need to get in here and we need to do some issue spotting so that we can help these folks. And as a matter of fact, we already know, honestly, we tend to think that when we run into these business owners or any wealthy people who have an $11 million asset or an $11 million estate, excuse me, we tend to think that they've already gotten all the advice they need. But if you look in this fact pattern, they have a will and nothing else, right? So the first thing that we really need to do is we need to watch out because that's actually on wheels. And I almost pushed it right off of the stage there, which would have been a little embarrassing. And my friends from Mutual of Omaha would have never let me forget that one. So these are the issues that I looked at. Not bad for 45 minutes, right? We're going to look at the estate taxes just really briefly. We're not going to talk about a lot of solutions there. Some basic estate planning documents. Think that's too basic? You know what? They only have a will now. So we'll look at that. Estate equalization, special needs planning. Life insurance has an income tax planning tool, non-grantor trusts, and charitable giving. Man, that's 45 minutes worth right there. Okay, so the first thing that we like to talk about in this industry is, do we have an estate tax issue here? And we love to talk about it because we love to say, oh boy, 40% estate tax rate. That means that we look at the amount over the exemption and we're gonna write a nice life insurance policy to cover that. Might be second to die, might be first, a single life. But we're going to get a life insurance sale because it is clearly the most efficient way to pay for those estate taxes. But the problem is when they raised that exclusion amount to $11.4 million, then that became extremely difficult for us to find people who had to pay estate taxes, right? I mean, honestly, $22.8 million excludes all but a very, very small fraction of the population. So we really need to look and say, all right, well, if we have portability and people who are married can have an estate worth 22.8 million, which is going to be indexed for inflation, then maybe we need to consider who actually needs to do estate tax planning. Okay. Well, number one, I need you to take a look at this when this sunsets. It's on December 31st, 2025. So what I would encourage you to do when you're talking with your clients who are in this middle range, right? The middle range we'll talk about. Am I going to pay estate taxes? I don't think so, because the law says that I have less than, well, the law doesn't say I have 22 million or less. I have 22 million or less. And the law says I don't pay estate taxes. Now, we all know that that is going to sunset in 2026. And so it's a very simple question. We just say, do you plan to die before 2026? And if the answer is no, then we still have estate tax planning to do, right? And, you know, you can get into the whole political discussion if you like about who's in Washington and what their political views are on the estate tax. I do my best to avoid that. So I try not to do it. Now, here is what I try and do is the simple swipe at who has to do estate tax planning. Number one, if you have an estate that is greater than 22 million or will grow to that, you have an estate tax issue. That's easy. You do all the same planning that we ever did with this, okay? Now, if you have an estate and you're married and your estate is never going to get to 10 million, no matter how long you live, you don't probably have an estate tax situation. So then the question becomes, okay, well, what if I'm in a situation kind of like the folks in our example? They're at $11 million right now. So clearly, if they die while this current law is in effect, then they are not going to pay estate taxes. But if it does sunset and it goes back to $5 million indexed for inflation, they are going to pay estate taxes. So we need to do some estate tax planning with them, but we really need to have some flexibility in how we do it, right? So that's going to be important as we move forward. But what do we have to do before that? Well, we have to go back and talk to them about readdressing their will. And we were just talking yesterday, as a matter of fact, about the many times that you have to go back and look at your will because of your change of circumstances, things like that. One thing that I'll throw out to you is that if your will is more than a few years old, then it does not address your digital assets. So are you on Facebook? Do you get email? Do you have any digital assets at all? Your will probably does not address that. So everybody who has a will more than a couple years old should be looking at that. But in this case, we really need to think about who should and should not get these assets, right? We have one child who is in the business, but let's be honest, we don't know from the fact pattern if he is going to, if he's a doctor or not. We don't know if he's going to come into the business. And so we need to find out through discussion with them who should and should not get assets. Some of them maybe should, some of them shouldn't. And we also have a special needs child, so we'll address that as well. Who should be the guardian if you have minor children? Now, I put that in, granted there are no minor children in this particular thing, but we do have a special needs child, so we want to make our desires understood with regard to who might be the guardian if we don't currently have a guardian for that child and if the child actually needs one. So, and then lastly, we have to have a discussion with people about who's capable of being this personal representative. That's a really hard job. And if we have a difficult job, then we need to have somebody who not only knows what we want to do, we need to have somebody that has the skill to wind down their interest in this business. And that is not going to be easy. So these are all issues that they need to go and sit down with the attorney about, but you can disturb them into some action. Okay, so what other documents should they be considering? Of course, a power of attorney and a medical power of attorney, or a medical directive or healthcare power of attorney, right? Because we need to have someone make the decisions for us when we can. And as basic as that sounds to everybody in this room, we know that they didn't have it because they never said we have a power of attorney or a healthcare power of attorney. So why in the world are we not addressing this? How does their entire plan completely fall apart if they have to go in and fight over a guardianship, fight over a conservatorship, right? So have that discussion with them. And maybe even more importantly, we have to talk about the end of life instructions. How many of you are familiar with the Shivo case some years ago? Absolutely tore apart a family, tore apart a family. Parents wanted to keep the daughter alive. Husband thought they should let her go. And however you feel about that particular situation, the one thing we know is that she could have avoided that whole situation if she had done a living will. So these people need to address that situation. And let's be honest, if you work with business owners, there's one thing that you know, and that's that a lot of times when you have a successful business, you have an equally dysfunctional family, right? Those skills that taught you to boss people around and do all that and be successful at your business do not always make you a great parent. So I think that anytime that we can find a way to remove some source of conflict for this family, we absolutely have to do it. So look at the living will. They specifically asked for a living trust, which is great, right? They have a lot of assets. I think that that can really make sense. They may want to do their asset management. They can do something additional either with this or with a testamentary trust where they can not only address who gets the assets, but we're going to address when they get the assets. This is really important. This is an $11 million estate. And they, as far as we know anyway, they are first generation wealth. And first generation wealth feels a little bit differently about cutting your own grass and doing things for yourself than the second or third generation does. So if we dump a bunch of money on them, then that's going to be problematic from mom and dad's point of view for a lot of folks. We don't know that yet with these people because we haven't had that conversation. But it's a wonderful conversation to have. So we're going to do that. We're going to talk about spendthrift provisions. So sometimes we have a child who should never come into money, right? I have 4 children now, and I'm starting to think that 4 of them might have to have spendthrift provisions, right? So that's a wonderful reason to do a living trust, right? It's not going to protect the grantor, the settlor, the trustor from the creditors, from their own creditors, but it can protect the children from their creditors. And those creditors aren't just the people that you're running through the stop sign and hitting. A lot of times they are a future ex-spouse, right? So they're going to get married and then probably get divorced and then married again. So we can manage that situation. I know in Omaha, there was an attorney who was speaking, and she said when they draft their trusts, they make their distributions at age 50. 50. My voice is cracking. How do you like that? At age 50. And we all started laughing. We said, why in the world would you make the first distribution at 50? And she said, because we want to get them through their first bad marriage, right? So we might really be worried about that in this situation. And then, of course, we can remove it from probate. But for Pete's sake, if the attorney who drafts it doesn't talk to them about putting assets into the living trust, then you need to, right? You need to say, all right, you spent the thousands of dollars to draft this living trust. Is there anything in it? And if there's nothing in it, you are not avoiding probate, right? That was their stated goal. We want to avoid probate. It was the one reason they brought this up. And everybody fails them in a lot of cases because the attorney might draft it. It says Exhibit A on the back of the trust. I hereby transfer all of my assets to the living trust. Okay, that's great. But then nobody changes the title to the house. Nobody changes the title to the cars, any of the investment accounts, right? And so we really, really are not accomplishing what we think we're accomplishing with the living trust if we want to get it out of probate. wonderful service you can provide for people. Okay, I mentioned this before where we were talking about estate equalization because we have these 3 children, and frankly, we don't know if 2 of them are going to come in the business, 1 of them, or none of them. And so we need to find a way to provide for these other kids. And we have a really complex situation here, right? Because here we don't just have a family business that we're trying to split between a few kids. We also have siblings at that first level. We're going to have a buy-sell agreement, and we have this really complicating factor where our client here wants to pass his interest on to one of his kids, right? All doable. We can do this. There can be an elaborate buy-sell agreement that handles that. We can do all the estate planning documents, but it's not easy. So we need to start planning for that. And what are we going to do for these other kids? Well, we could obviously leave the entire business to all the kids and let them fight it out, which is terrible, right? And they do it. They do it all the time because they don't want to have the conflict that comes with telling your children that you get this and you get this. So we have to have that conversation to say, all right, so-and-so, oldest child here is going to get the business, but we're going to give you some life insurance. We're going to give you some walk-in money, right? And when we do that, we accomplish a lot of things. Number one, we're going to help the business continue, especially because we have uncles here and an uncle and an aunt left in the business. So we have to get these non-participating kids out, not just for the benefit of the one child, but for the benefit of those siblings. And it also does another thing, and that is if you talk to people about their estate planning, most of the time, this is my experience, what they really, really want isn't, they don't care about the estate taxes that much. They don't care who gets grandma's piano or a certain piece of jewelry or something like that. What they want is they want their children to get along after they die, right? Which oddly is the reason why they won't have the hard conversations while mom and dad are alive. But we can help them at least talk about how we're going to manage that post-death. And estate equalization is a great way to do that. Because if you're in the business and you're the heavy one, right, the one who just comes in and soaks up the profits and never provides value back to the business, that's going to cause a lot of angst for the person who's good at running the business. And if the person who's good at running the business is also good at squeezing out the people who aren't good at the business, then we are going to have another problem that we need to manage. So when we get back to Thanksgiving next year, we need to have these kids separated, right? They will all show up at the table if everybody went their own way. And what a better way to do that than with life insurance. So this is just rapid fire, I know. So anytime that you guys want to stop, ask a question, make a comment, anything like that, just let me know. But we have a problem. We have a problem in that we love the estate equalization idea. We're going to do that, but gosh darn it, we have a special needs child. So what happens if we leave a lot of money to somebody who's qualified for benefits for public assistance? You disqualify them, right? Until you spend down all of those assets. So you might say, oh, well, hey, we'll spend them down and then they'll go back on. But that's even more problematic because then they have to requalify. And what if that program that they were a part of was actually their community and you just kicked that child out of that community by making this so that they could no longer qualify for these programs? So instead, maybe we should be thinking about a special needs trust. Now, I'm not saying we have to do a special needs trust because they're not right for everybody, but we at least need to consider this. Because with the special needs trust, we can preserve our governmental benefits, right? We can satisfy our previous desire we talked about to protect the assets from the creditors, right? Because we're not going to let the special needs child's creditors come and get those assets. And we're going to provide funding for additional care and services, haircuts, vacations, computers, TVs, right? How do we do that? We do that by making it so that the trustee, some people might say that they can have absolute discretion. I'm not weighing in on that, right? Most of the time when we see these, we say the trustee cannot pay for things that the government would pay for, essentially. So they can't pay for the basic needs, the food, clothing, the food and housing and medical care. So we have to restrict their ability to do that and only use it for supplemental needs. Because if you're making those payments, a lot of people qualify for Medicaid indirectly. And what I mean by that is that they qualify for SSI. And once you qualify for SSI, in a lot of states, that means that you qualify for Medicaid, right? So what happens when you start reducing your SSI dollar for dollar? You lose your SSI. Sound bad? It's really bad then when it goes to zero and your ticket to the Medicaid is now gone, right? Now you have to qualify for Medicaid in a different way. So that's going to be very, very important that we only use it for supplemental needs. Now, I think that we should all have some passion here, right? It's hard to make a market in special needs planning if you don't have some affinity with a group, right? And now everybody obviously knows someone with a special needs child, but it can be challenging. But when you come across these cases, it's so, so important that you take the care and make sure you're not disqualifying them. Because the difference for that child, in my mind, is on the one hand, they have a life of substance. On the other hand, they have a life of subsistence. And it's all because we didn't pay attention when we were helping people make their beneficiary designations. So please, 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 when you ask that question, make sure that you're investigating further and resolving that issue. Now, we said before that maybe they have an estate tax problem, maybe they don't have an estate tax problem. And we also know that there are a lot of people who clearly don't have an estate tax problem. So for them, income tax planning has become the new estate tax planning, right? So we're going to talk about a lot of things about keeping things in the estate so that we can get a step up in basis, things like that. But for this room, this is a NAIFA meeting. We all have passion about life insurance and should have passion about life insurance because it is an amazing tool for managing income taxes. And the reason it is, even though we don't get to take a deduction up front, unless I suppose you're putting it into the qualified plan, we know that the growth inside of it is growing income tax deferred. We know that if it's not a MEC, that we can take withdrawals and loans without taxation. And maybe even most important, we know that it's going tax-free to the beneficiaries. So when we start talking about income tax planning for the passage of wealth, for the transfer of wealth to this next generation, we know that not all assets are created equally, right? We know that capital assets are going to get a step up in basis, so they're good assets to pass. We know that IRD assets do not get a step up in basis, so the gain in a non-qualified annuity, your IRA, your qualified plan, those are difficult assets to transfer to the next generation because they have so much income tax built in. And then we compound that and we say, wow, what are we at, 22, 23 trillion of debt now? Do you think income taxes are going to be higher or lower in the future? Most people, and I have no crystal ball. I know that every time I guess about what Congress is going to do, I'm thinking logically, and they never, ever do that thing, right? So the only thing I can say is that our clients, for the most part, are pretty logical. And they will say, oh, well, I think income tax rates have to go up. And so you say, okay, well, that IRA that you have that's worth $1 million, how much is that worth to your beneficiaries? And they say, well, the top income tax rate now, if they took it all out in 1 year, 37%. So I suppose that's worth about 630,000. Okay, well, go back to 82, and we know that we had really, really high income tax rates then, and we think that the income tax rates are going to go back up. What if income tax rates go back up to 50%? What if they go to 60? Whatever the case may be, whatever they think the likelihood is, it doesn't matter. There's no right or wrong answer, right? None of us has a crystal ball. What we can say is $1 million death benefit is $1 million, right? There's no taxation involved. You want this one child to have $1 million, you buy a life insurance policy, and we know that they're not going to pay income taxes on that, no matter what the rate is. So that's why I just, I think that sometimes we don't embrace life insurance for the amazing tool that it is to supplement a financial plan. And this is a great way to transfer wealth, obviously. So when we are doing our brainstorming, of course, we're looking at the income tax planning. We're talking about the estate tax planning, and we're talking about the charitable giving. That makes for a lot of issue spotting. And that means that you have to do a great fact finder. And it means you really have to spend time with people. And you have to spend time with people not just gathering the facts, because the facts don't matter. What matters is how they feel about what they want those kids to get, right? Everything else is secondary to that, and you guys know that. If you have a $100 million estate and you think it's going to ruin your kids, are you really looking for your advisor to tell you how to maximize the amount of money that goes to your kids? No. No, you want somebody to help you, because you want to know that those kids are going to be okay after you're gone, and dumping a bunch of wealth on them might not make them do well in the future. So we have those conversations with people. Now, this is a relatively new technique that I wanted to share with you today, because this is the triple Lindy off the high board, and it's fun to do these things every now and then. And it's talking about planning with non-grantor trusts, okay? When we're talking about non-grantor trusts, I think we need to level set first of all, of course. So I think you should reasonably be asking, what is a grantor trust and what is a non-grantor trust? Or the rest of the presentation really doesn't matter, right? So here's what a grantor trust is at its core. A grantor trust just says that it is not itself a taxable entity, right? Or it doesn't pay those taxes. All the tax consequences flow back to the grantor. If you have a non-grantor trust or a complex trust, that means that the trust itself pays income taxes on the income, unless it distributes that income to a beneficiary, in which case the beneficiary pays it, right? Does that make sense? Grantor trust, grantor pays all income taxes. And non-grantor trust means that they don't pay, or that the trust pays it unless they distribute it to a beneficiary. So let me ask you guys, why in the world is anybody subjecting themselves to pay the income taxes of a trust they create when they no longer have access to that property? Why would you ever want to do that? Yeah, you're right, because the primary reason is that the trusts hit the top income tax rate at just over $12,000, right? $12,000, and then they're paying at the 37% rate. So if you can shift those taxes either to a grantor or to a beneficiary, most of the time you're going to be better off, unless that grantor or that beneficiary themselves is already in a 37% bracket. But they don't get there for a long time, right? So in most cases, it's a great income tax play. But there's also a good reason to do it from a gift tax point of view. And the gift tax point of view is this. If I make a $15,000 gift to the trust every year, that's great. But if I make a $15,000 gift to the trust every year, and then I have to pay $5,000 of the trust taxes, I actually made a $20,000 gift to the trust, right? I just don't have to pay gift taxes on $20,000. So it's a great way to leverage. You get great income tax treatment, and you also get good gift tax leverage. But the opposite is true. Why would somebody not want to do a grantor trust? Anybody? Well, it could be that. What I'm driving at with this particular question is we see a lot of people who put in assets, especially assets that are not spitting out a lot of income, right? And they say, oh, this grantor trust thing is fine, if they even understand that, right? Then all of a sudden your trust property starts spinning out a lot of income and people are paying taxes on assets that they can't have back because it's an irrevocable trust. And they don't like that, right? So sometimes you can say, oh, wait, though. It's mathematically better if you pay those income taxes. And I don't care if it's mathematically better. Let somebody else pay the taxes. I gave that property away. So that's a really, really good reason to do a non-grantor trust. Now, I would probably defer to someone like Kathleen on this, but I have heard that some people will put a trigger in a trust and allow you to flip off the grantor. Wow, that's not where I wanted to go with that, was that? Turn off the grantor trust status if you want. Now, you probably are not able to flip it back on, but you can turn it off at some point in the future. So that is the really, really long explanation of grantor trust. That's why we traditionally have done that, right? We wanted to do that because we wanted it out of the estate when we used an irrevocable trust. So we wanted to have a completed gift, but we wanted to manage our income taxes in the best way possible. But now we have this new thing, and you may have heard of them, INGs, DINGs, WINGs, AKINGs, I think Alaska uses that. So an ING is an incomplete non-grantor trust, okay? And what that means is that we are creating a trust that, now I called it an incomplete trust. That's a decision we'll have to make, right? So we can either make it complete and get it out of our estate, or we can make it an incomplete gift in which it's not out of our states. Maybe we have a reversionary interest or something where we have to consent. But the reason that we might want to do that is you guys here in Texas are lucky, but maybe the people on the simulcast are not. You guys don't have an income tax here in Texas. A lot of us have pretty hefty income taxes, right? We just had Pac Life up here. I know California is a delight that way, right? So if you can transfer assets to a non-grantor trust in a state that doesn't have an income tax, you might not have to pay state income taxes, right? So maybe I take it to an Alaska trustee. And assuming this, it's a new planning technique, right? So nothing is bulletproof. Work with a good lawyer on it, but have a nexus with that state. Have a trustee in that state. Set up the trust, and then maybe when you have income in the trust, you won't have to pay state income taxes. Now, what's the counterpart to that? You have to be really, really careful here, right? This works really well for people who are in a 37% income tax bracket. Why? Because if we move these assets into a non-grantor trust, we know that the trust is going to start paying income taxes at 37% rate when it has just over $12,000. So this really works well if your grantor is already in that income tax bracket, right? Because if the grantor is paying income taxes at 22%, why in the world would you shift it to a non-grantor trust and have the trust pay 37? That would be nuts, right? So we wouldn't do that. So that's one reason why we might want to use it. Another reason, and this is really, really clever. I saw Marty Schenkman, if any of you have seen him speak, just one of the thought leaders in the industry, really smart guy. And he was talking about how to get a charitable contribution and have that removed from your income, even though you don't itemize. So this is going to be maybe for some people who have a little bit less income. Okay, so I have $24,000 standard deduction right now. I know that the state and local income tax, or state and local tax, is going to be limited to $10,000. and then I add on my charitable contributions. If that's not over 24, then I'm not really deducting anything, right? I just took the standard deduction. So what this idea is, and I hope I do it justice, is what if I take a few $100,000 and I put it into this incomplete, or I put it into this non-grantor trust. And what I'm going to do then is I'm going to instruct the trustee that they are to make distributions of the income to charity. Because trusts don't have a standard deduction, right? So it can spin out all of that income. It doesn't have a 50% of AGI limitation like a person, or 60%, excuse me. 60% of AGI limitation like a person does. So it could spin all that out. Now, did you deduct it that first year? No, because you contributed it to a non-charitable trust, but that income that you would have had yourself every year thereafter, 10,000, 15, whatever that is, we know that it's in the trust and that the trust is contributing it to a charity. Now, what if we put in some more? This is where this idea gets really cool, I think. That is, we're going to spin out all of the income to the charity, but what if we give the trustee discretion to spin out some of the corpus to our non-charitable beneficiaries, right? Then we know that the income taxes are being taken care of because the income is being paid to the charity. And we also know that the kids are going to get some money out of it too. So it's a really, really cool. Does that make sense? It took me a little while to really get that. He did a good job, but once you sit and think about it, it's, oh yeah, that's a great idea. And we already talked about the SALT tax limitations. The last thing I'd want to mention with this is it a complete or an incomplete gift? And the answer is, traditionally, before the estate tax law changed, we made them incomplete gifts, right? And the reason we did that is that we didn't want to have the gift tax associated with contributing this to an irrevocable trust, right? We did this because we wanted an income tax benefit, not an estate tax benefit. But then all of a sudden, Congress comes around and they say, you know what, I'll tell you what, let's give you $11 million worth of exemption, and you better use it before 2026 or you're going to lose it. And so now people are saying, why wouldn't we maybe make it as a complete gift now? What if you wanted to put $10 million into a trust like this? You would want to use up your gift tax exemption, right? Use it or lose it. We know that the Treasury has already said they're not going to claw this back in, right? So if they're not going to claw it back in, use it. And don't use it between Christmas and New Year's in 2025, right? That's what we saw back in 2009, and it's a disaster. It is a disaster when you do your planning like that. I joke about it, but it's absolutely the truth. We have a nice window of time that you can do some good planning for people that doesn't just manage their taxes, it manages their family situation. And so why wouldn't we get that started? Okay. And so I wanted to talk a little bit about their charitable desires. And if you read through this, you will find there is nary a comment about their charitable desires. And by raise of hands, how many of you guys have your clients regularly bring up their charitable desires to you? One. That's exact. Two. Thank you. All right, we doubled our number right there. So we have two people out of this entire room. And you know what? Those people are expecting you to bring it up to them, right? And so sometimes that's a difficult conversation. But these people have $11 million. They may have a charitable desire that has nothing to do with maximizing their income tax, right? We could talk about, in this industry, both legal and in the planning, insurance and financial services industry, we have a real tendency to say, oh, you should do some charitable planning because of all the wonderful tax consequences you can get from this, right? Contributed to a charitable remainder trust, you're going to get a deduction and a stream of income. contributed to a charitable lead trust, you can either get a deduction or you can get it removed from your estate. And those are wonderful things. But the thing that we always forget to ask then is, oh, are you charitable? Is there any charity that is significant to you? Right? So let me ask you, I'm in a study group for the Chartered Advisor in Philanthropy back in Omaha. And one thing I've learned while I was in there is that there is another city that has a really good study group for the same thing. And so I'm wondering if anybody is in that study group down here, because it's here in Dallas. It's the other one that's done it continuously every year for years. Okay, you should check it out because it's a wonderful eye-opener that we can take a step back from maximizing the wealth that we go to the next generation to start talking about how do you make this world you live in a better place, right? What kind of world do you want your children to live in, your grandchildren to live in? Is it really to anybody's benefit that you maximize the amount of money? So your clients are waiting for you to bring up the subject, and I'm even going to give you the first question. The first question is this: how much should your children receive? And then stop talking, right? Because every one of us assumes the whole thing is maximizing the amount that goes to the next generation. And that's not what they're thinking. That is not what they're thinking. They're thinking that one child has special needs, they need to make sure they need to take care of it. Another child's going to come into business, and we need to get that other child out of it so we can have family harmony. But we also feel really blessed that maybe he put himself through medical school, right? And that's how they started this practice. Whatever the case may be, a lot of people feel an immense amount of gratitude for the life that they are leading, and they want to move on and help the world and help the country and help all these folks, whatever their cause may be. So you ask this question: how much should your children receive? Because there's a hierarchy here. You guys know it. If you want to do any of this type of planning, level one, do I have enough for my wife and I to live the life that we want in retirement, right? And then there's sort of level 1.5, which is, are you sure I have enough to live the way I want to live in retirement, right? So that's first. Next, you will not get to charity until you find out what they want to give to the children. And if they say, we want to max it out, okay, well, done, right? That was super easy question. You found out what they wanted. But if they say, well, gosh, we feel really blessed and things have been wonderful for us. We're involved in this school. We're involved in this charity. Whatever the case may be, I would really like that to continue. And you can say anything you want at that point, right? You can ask them, what do you want to change or what do you want to preserve in this world? Because that's what we can help you with. But we have to have a conversation. So do that. Make this charitable planning part of what you do. And I will tell you that a lot of people will shut you down because of the way that we phrase it, right? If you sit down and it's a checklist of 100 questions and you say, do you want to leave any money to charity? And they go, I haven't really thought about it, no. And you go, okay, no's the answer. And you move on, you will get a no almost every time that way, right? You have to package this in a way that people are ready for it. So build your relationship. Find out what they're interested in. And then you have permission to ask them questions like this. So I think that is, it's just a wonderful opportunity. Estate planning is so exciting if we start to talk about the things, the way we can impact families, the way that we can impact entire communities. Because people who have a lot of wealth, in a lot of cases, are very, very charitable and kind people, and they need your help. So with that, I guess I would open it up for questions on this, and if we don't have questions on this, we'll bring everybody back up for the larger Q&A. Anyone? All right. Well, I want to thank you very much, and let's, Rob, do you want to take back over?
Yes, thank you, Ron. Then we're going to bring the panelists back up here for the opportunity for a Q&A. Oh, and bring your own chair. Sorry about that. We'll be one chair short, and Andrew doesn't like to be on the stage.
No, apparently not. I could stand on the chair.
Thank you. I think I'll stand over here. Oh,
You're standing.
I actually have, if I'm not jumping in front of anybody, I actually have a question, and it's maybe more directed to the panel generally, and we'll see who wants to respond to it. As I was reviewing the case and then sitting here this morning, hearing about these techniques and these strategies, I recognize all the technical aspects that you shared today. I appreciate some of Ron's remarks and questions about maybe the less technical relationship aspects. However, I'm curious, we're thinking about the attorney being involved. We're thinking about the advanced markets attorney being involved to support, I'll say me, the financial service professional. We talked about the CPA a couple of times. How does all of this coordination take place? When should the financial services professional reach out to advanced markets or to the attorney, Kathleen, and say, all right, I have some ideas or questions about this case? That's where I think some of the communication will break down. And I've always believed that our best potential outcome is through collaboration. So I'd like to have you speak to the collaboration a little bit. Whoever wants to go first. Bruce?
My experience has been that one of the people in the mix has to take the position of quarterbacking it and coordinating all the activity. And usually if you get a meeting or a conference call among the people who are going to be involved, I think that sort of sorts itself out, or at least that's been my experience.
You know, one thing I was going to throw in there, and Kathleen, can you hear me? I think I'm mic'd. Yeah, you probably could comment on this as well, is I would like to think that attorneys don't like to be order takers, so getting the advisor and the business owner in on the front end and just saying, I need a trust, I need a buy sell attorney, just write it up for us is probably what you don't want to do.
Just use your boilerplate. All we need is your boilerplate document. I can tell you my firm doesn't have boilerplate documents. We may have some standard language, but we don't have boilerplate.
But I would think, I mean, that does happen occasionally to you.
It does.
It puts you in a spot that you don't want to be in.
Yes, especially if you disagree with the recommendation. Because you never want to be sitting in front of the client and have the advisors disagree. It's better, in my opinion, to get everybody together even before the client meeting and have everybody on the same page so there's no disagreement at the client meeting. Everybody knows what the objectives are moving forward.
Yes, and I would agree with all that. I think a lot of our phone calls, we have Terry, our case design specialist here locally in Dallas, Paul. Sometimes it takes a village, right? It takes a couple of calls, but just get in touch with your field person. You can call any of us. I know that all of us are open to phone calls and setting up conference calls. A lot of times we'll get calls, hey, I want a little tutorial on buy sell, or I want a little tutorial on estate planning or retirement planning using life insurance before I talk to the CPA. I want to make sure I have some better knowledge about this before I start getting peppered with a bunch of questions from the CPA or the attorney. So yeah, I think it can be multiple.
One thing I notice, Stacy, sometimes is it's the attorney or CPA that will want to call you that doesn't have that life insurance knowledge. They don't want to look bad in front of their clients. We can't all be blessed with Kathleen's of the world, right? So getting them up to speed before you expose them to that panel of advisors sometimes happens too. Yeah.
If I may, I suppose I can since I have the microphone, but by way of follow-up, with this fact pattern, I'm always interested, and I know we are as well, in who's the client. And we've got 1/3, 1/3, 1/3 owners. It sounds like Robert was taking the lead on the planning. However, who is the client? And how do you address or deal with spending some time with Robert and the other owners, either independently or collectively?
Can I start this one? That is a terrific question. And we run into this all the time because we do represent business owners. Sometimes the client will actually be the business, and we're actually representing the business. In a situation like this where we have 3 owners, there could definitely be conflicts. So one of the things that we have to get up front is a conflicts waiver from everybody so that we can represent everybody. Otherwise, we're going to be in trouble, lots of trouble. And sometimes we put those conflicts waivers, for example, in the LLC operating agreement. If everybody's signing off on an operating agreement, we may put in there that we represent the company, no individual shareholder. They're welcome to get their own advisors to look at it, which 99% of the time they don't do.
I don't have any further comments on that.
No, I don't have much to add. I think we're fortunate in our industries that we don't have as much of that conflict of interest problem as you do, right? We can represent a whole lot of people in a family until their interests become adverse. But yeah, it's not nearly as tough as with bar cannons.
For the Pacific Life Advanced Designs Unit, you are our clients. We can talk to you and we can talk to your clients' advisors. We just typically don't talk to the clients unless their advisor or CPA is present on the phone or something. We just make sure we're not representing it. Kathleen is representing as an attorney. The majority of our department's attorneys, but we're not representing the clients. We just make that differentiation. But you're our client.
And I'll just add one more thing. The rules of professional conduct say that the client is the person that you represent, but that doesn't necessarily mean that that's the person that's paying the bill. So we also have a lot of situations, for example, where as a benefit to the executive group, the company will pay for their estate planning work. We're still representing those individual executives individually, even though the company is paying the bill. So who pays the bill and who's actually the client are not necessarily the same thing.
You know, it occurs to me, Rob, that I'm curious if somebody from the audience has an opinion on how they coordinate that circle of advisors, the attorney, the CPA, the client, sort of magic formula that one of you brave souls have conquered and figured out. Does anybody have any thoughts on that from your perspective? Come on, crickets?
Doesn't it depend on who has the closest relationship with the client? I mean, generally.
Yeah.
You know, sometimes it's the CPA, sometimes it's.
Yeah, I mean, sometimes we're trying to figure out what our role is, and we kind of have to kind of choreograph how we're gonna work with you. I've been in situations where, you know, I don't represent the client. I'm an advanced markets person. I don't want the home office person on the line. I just want the attorney. I want the CPA. I want the business owner. In other situations where I wouldn't do it without Ron. I wouldn't do it without Andrew on the phone. I want them talking to the attorney and the CPA and have them part of that circle of advisors right up front. So you're right. It does just kind of vary facts and circumstances a little bit. I didn't know whether or not anybody had a magic way that they necessarily did it or not. Yes.
It also helps if you develop relationships with those CPAs and attorneys beforehand, so that then you're part of the team.
Good point.
This is a linked question.
Rob, I think we have a question back there. I don't know why.
I didn't see the hand.
Yeah, he's got it first.
So I think this is a Stacy and Bruce question, and that split dollar defined benefit concept you presented. Great job, by the way. I have an asset protection question. Take these single pay long-term care hybrid life policies like MoneyGuard, One America, for example. And traditionally, the life portion of that is non-deductible and the long-term care rider portion is deductible. But what you suggested was there may be a way to make the whole thing deductible. Am I misunderstanding that?
And you forgot Premier Care. But I'll let that go.
Sorry.
That's okay.
There's a bunch of really great ones out there.
Just had repricing. The great question, and Bruce, I'll take this one, I think. When we talk about, anytime we came out with our Premier Care product, our long-term care, it's either universal or whole life chassis with the long-term care riders. It's predominantly a long-term care product. with a little bit of death benefit, we had to vet, like, okay, who can own this policy? You know, individually owned, certainly. What about moms on daughters, you know, dads on sons, kids buying it on for their parents? One idea. Qualified plans came up. For our products, we don't see it as being a great idea to have our long-term care products, either Premier Care or our policies with the long-term care rider inside a qualified plan for a bunch of reasons. Qualified plans, anytime you have a policy inside a qualified plan, it needs to be unisex rates. And Premier Care does not have unisex rates. There's another issue of anytime you have qualified plans, you want to make sure that you can get the benefits out of the plan. Or sorry, anytime you have a long-term care policy, you want to make sure you get the benefits to the policy owner. That's state suitability rules require that. And now not all states have suitability rules, and the states that do, they're not all the same kind of rules. But for Pacific Life, we had to determine kind of one way of handling everything. So we follow all the state suitability rules and the model compact states and all that. The idea is we don't want to sell those people to, sell the products to people who can't afford it or don't really need it or whatever the case may be. So getting the LTC benefits out of the plan could be somewhat problematic. We think it could possibly have issues with, causing that qualified plan to be unqualified, which would be very bad. So we don't allow our products to be owned inside a qualified plan. But our other products work great. CIR, chronic illness rider, is not as much of an issue. Eventually, you're right. Eventually, if you're going to get that policy out, why can't I have Premier Care? I'm going to get it out of the policy, or the policy with the LTC rider. If I'm going to get it out of the policy before retirement anyway. But what happens if you need that long-term care while it's still in the plan? It just causes all kinds of problems. So, but other ownership is pretty wide open. Did that answer your question? Okay.
There was a question or a comment regarding bonusing out a policy out of the 401k plan or something. Are insurance companies using net cash value, gross cash value, interpolated terminal reserve? Is that really kind of dependent upon the company?
It should be, to my understanding, the greater of ITR or PERC. You want to talk in more detail about that?
Yeah.
Safe harbor.
What happens is there's a revenue procedure 2005-25 that defines the value of products. And in there, it gives a safe harbor of PERC, which is premiums plus earnings minus reasonable charges, which sounds a lot like cash value without reduction for surrender charge, which is the term they use. They also point out that if ITR is larger, it may be a better measure. But ITR is not a particularly good measure for, UL policies or interest-sensitive whole life policies.
I know that, Bruce, that some companies will give you the ITR. Some companies will not give you the PERC because there's not an agreement on what that means.
Some will give you all the values, the PERC, the ITR, the accumulated value, and the cash surrender value, and say it's up to your CPA to determine which is the best measure.
Well, and I think that 2005 ruling only applies to qualified plans.
Correct.
So if you have different situations, it may be one of those other values that we're going to use.
It also applied to 79.
Yeah, Section 79 plans.
I mean, I've had situations, Kathleen, where it's like, okay, I realize, Andrew, this is a safe harbor. I don't like either of those values. I don't like the PERC. I don't like the ITR. I'm going to get my own actuary to figure it out. And I go, you know what? Feel free to. These are safe harbors, but we're not going to be involved in it. You could always do that.
Right.
We're not going to police it.
Yep.
So,
No, I have not written a book. I've been asked many times whether I thought it was a good idea or not. Who can find the time? You should. Thank you. That's very kind of you to say. I think we have a question from our virtual audience.
We do. And the question is really about navigating the relationships between, let's say, the attorney, the financial advisor, planner, the CPA. And so the question really pertained to, for the financial advisor and the insurance agent, if when working with attorneys, so the attorneys, could you respond to this? When working with the attorneys, if the feeling is that the attorney's either not on board or maybe doesn't really get how to do this, do you have any advice on how to navigate that situation so that you can actually create a really working relationship? And the subsequent piece was, what if you need to kind of disinvite the attorney from the party? Like, what would that look like?
Good luck.
In a very gracious manner. And I paraphrase some of that.
I mean, I could answer it from a home office carrier perspective, and maybe somebody else can hit it, or Kathleen from a real attorney perspective. From my perspective, I mean, you know, I gave it the practice a lot when I started working for a corporation, so it's gone now. But what I'll typically do is I'll get together with that attorney separately. They do not want to look bad in front of the client. That's human nature, right? I can't tell you the number of times where I've approached it wrong, where I've had the interaction with the attorney and the client and the advisor all in the same room, and I'll get pushback from the attorney, only to find out later they don't really object to it. They just don't understand the concept or the strategy per se. And then with time, I've learned, I know you've run into this too, if you take that attorney CPA aside, say, okay, let's talk attorney to attorney CPA and nerd out with them, because it's just the two of you. Let's talk about that 1377A2, you know, short year election for S Corps that you can only use with cash basis, and, you know, do that with one another, and then the barriers kind of come down, and then, you know, re-invite them to that larger discussion a little bit later. So from a home office kind of advanced markets perspective, I found that to be effective with the advisors. Just take them aside and work with them.
So could we extrapolate and say, would your advice be actually that the advisor should be really the first mover on that? If like we were to say what creates an ideal working relationship is for the advisor to kind of take the lead on that with the attorney.
I mean, oftentimes the advisor will advise just that. And if they don't, you know, I will, then I'll work with the advisor, letting them know what I'm doing. But you cannot leave, obviously, the advisor out of the equation. Yeah.
I think it's the person who is suggesting a solution that has the obligation to pre-handle it with the other advisors, because none of us like surprises. I used to like them when I was little, because my mother
a pony. Everyone likes a pony.
Nobody likes surprises. So I think that's the guiding rule for me, is that if I'm the one that's promoting an idea, then it's my obligation to pre-handle it.
If I can jump in real quick, I think there's one great piece of advice that I give it all the time, so hopefully it's great. And that is know your role, right? Because there's nothing that will poison the relationship with your fellow advisors as much as saying, I think it's really stupid that you don't want to send out crummy notices. You know, it's not your role to make those types of decisions. And as soon as you start taking the place of other people's judgment, you are on the outside. So then the next question is, all right, who gets kicked off of this? And the answer is the person who gets kicked off is the person who's not already the most trusted advisor. Am I right? If you tell me, if I go back to the client and I say, we got to get rid of Kathleen, she doesn't want to do anything I want to do. And they say, but Kathleen's my lawyer, and you know what? She's the one I trust. Guess who's out? It isn't her, it's me. So understand what your role is on the planning team, both in not stepping on other people's professional judgment, but two, also understanding that when the industry says you should be the quarterback in every relationship, the industry is wrong when they say you should be the quarterback every time, because the client will choose the quarterback and it might not be you. And that's okay. That's okay.
And I'm from St. Louis, not Dallas. And of course, we no longer have a football team. But as I recall, from when we did have a football team, there are more players on the field than just the quarterback. Even that's who everybody always talks about, the quarterback, but there are lots of players on the field and they all have their job to do. They all have their role. I was just going to comment, you know, we've all had that situation where the client's attorney is his brother-in-law or his niece or something like that, and they know nothing about the topic that you're asking that they help with. You know, I've had calls from producers where they say, would you be willing to consult on this case and help this, you know, 27-year-old attorney get this split dollar agreement right? Sure, you know, that is another avenue. But sometimes it is required that some player on the team be replaced. And everybody's looking out for the best interests of the client. That's the most important thing. And sometimes the initial team is not going to be the team that brings it over
Across the goal line.
touchdown line, the goal line.
You're from St. Louis, you would know.
I just wanted to add, because there's a few of us that are practitioners, my perspective on this that may resonate. I first started charging consulting fees in 1997, and it's just continued to evolve. But when you charge a fee and you're being paid for your independence, I've had those conversations with the client where I would say, yeah, your nephew attorney doesn't appear to have the experience that we need to get this done. And oftentimes with that candid conversation with the client, the business owner, he or she would say, yeah, I was curious about that, or I was concerned about that. Thank you for bringing it up. So I always talk about making the unspoken spoken. And I think the communication, as we're talking about, is significant, because with the end in mind, it's what's best for that family, not what's best for me or any of the other advisors. So I like charging a fee for independence. Suzanne, anything else coming in? Anything from the floor? I don't want to rush you, but I don't want to keep you. Here's how I'm feeling. You took a chance. Took a chance with your money and your time to be here. Level up. You look at the speakers, the topics, say, let's see what's going to happen in this room. I appreciate your trust in the society and in NAIFA. I learned a bunch today. If you have a nugget or two, I think that would be fantastic, where you would go out of this room and say, you know, not only thanks to those that are here on the panel, but also NAIFA and FSP for their effort to collaborate, cooperate, and bring you this valuable education. So with that, I can call the meeting to close. Thank you all for being here.
Thank you. Thank you.